Okay, good morning, everybody. Okay, welcome to the second day of the workshop. I'm Mike. I'm going to be taking you this morning, and Daryl will be back this afternoon. So for the questions and answer sessions, Daryl will and I will take them together. So hopefully you submitted some questions overnight. So hopefully there are some questions somewhere that have been submitted. Otherwise, we'll just have open mic Q&A. So if there are any questions that have been submitted, just let me know where they are on the break so I can give them to Daryl. The idea is if you do submit questions in advance, we can think a little bit more thoroughly about the answers that we give you than when you just use the open mic. We don't mind the open mic. We're happy to take open mic questions. But we think the quality of answer you get might be slightly higher if you submit questions in advance. So every day, straight after lunch, we have a Q&A session answering any questions that you have raised in the day before's presentation. So you don't have to submit questions, but if you do submit questions like a day in advance, we can give a more thoroughly thought through answer to your question. Okay, so fine to use the open mic, just ask any question you want. In fact, when either of us are presenting, we probably don't mind, well, I certainly don't mind if you just ask questions as we're going along. That's absolutely fine. But we find at most workshops that we do, it is, some people like to submit a written question rather. That's fine, we're happy with the written question. Okay, but then we just answer it the next day after lunch, and perhaps it allows us to give you a better quality, a better thought through answer. For one, it allows the two of us to discuss it together rather than just one person answering off the top of their head immediately. But it's up to you. Gordon, I just see, okay, you're sorting that one out. Perfect, thanks. Okay, so we're going to go through a regulatory update this morning. Basically, what a regulatory update is, I follow some regulators very closely in everything that they regulate on IFRS. So basically, in this session, I want to go through the regulatory actions that they have taken in their jurisdictions where people are applying IFRS and they're saying, you're not doing this properly, you're not doing this properly, you're not doing this properly. Okay, and I think the problems are pervasive across the whole world. So if the problems are in one jurisdiction, they are probably in your jurisdiction too. So it's a nice way of having a look at where people are doing desk-based reviews of financial statements. The regulators are doing that, and they're saying, here are the problems we're finding. So the jurisdictions I focus mainly are South Africa, where I and Daryl originally come from, and the UK, where I live now, because those regulators publish every year their findings on the regulation that they have done in the year. So they review financial statements and they say, here are the things we found that were not good in the financial statements. And sometimes they will say, here are the things that were really good in the financial statements that we reviewed. And the reason why they're doing that is to try and improve the application of IFRS. If they can show people the mistakes some people are making, then others can learn from those mistakes. And if they can show examples of where people have done something really well, people can learn from where people have done really well. So the regulatory objective, the regulator's objective in doing this is to improve the quality of IFRS reporting. And the regulators in these jurisdictions, I think, are very kind. Okay, so if you look at their regulatory actions, they typically say, next year, do better. Okay, they typically don't make you restate your financial statements. In other words, they don't make you republish your financials. It has to be really, really bad. So maybe once a year, somebody gets told your financial statements are so bad that you must republish your financial statements. Almost everybody else is just told, next year, do better. Okay, you decide, is it a prior period error? Okay, or is it not material enough to be a prior period error? And then you do the appropriate corrections going forward. Okay, so the regulators are very kind, I think. They're really interested in building the quality of reporting. They're not so interested in levying fines and being punitive. You have to be really bad to get a fine. Most of the time, they're just saying, okay, you can do better. You've misunderstood this, you know, and they appreciate that over time, when you first apply a new IFRS, you are unlikely to do a very good job of applying the new IFRS because experience needs to build in applying that IFRS before you get to a really much better application of that IFRS. So the regulators are very aware of this and are trying to help the preparers to do better. If they see really bad, dishonest, cheating preparer, then they will take other actions. But most of the time, it's just, we can help you do better. Okay, over time, we expect it to improve, basically. That's basically the attitude of these regulators. And I think it's really helpful that they publish the findings that they have, because by publishing those findings, it's available to everybody, not only in their jurisdiction, but in all of the IFRS world. So every year I look forward, it's very sad, I look forward to these new, you know, this is what we found this year, publications that come out, because it helps me understand how people are applying IFRS and where they could do better. Okay, so it's interesting stuff. Okay, so sorry, I just do have to say, because I'm a member of the UK Endorsement Board, so the UK Endorsement Board is like FRAG to the European Union, except we are responsible for actually deciding whether each new piece of IFRS is used in the UK or not. So because I'm a board member at the UK Endorsement Board, I have to say whenever I speak anywhere that nothing I say has anything to do with the UK Endorsement Board, and they probably may or may not agree with anything that I've said anyway. Okay, so I just need to have that disclaimer. Okay, so the version of IFRS that we're going to be looking at is the version of IFRS as issued by the IASB 1 January 2024. So the version of IFRS that you would be applying if you were using IFRS as issued by the IASB at 1 January 2024. Okay, so we're hoping that we can help you develop a better understanding of these accounting requirements. I mean, that's what we're here for, to try and help you understand this better. And then to try and, in particular, to help make it easier for you to make the judgments that are necessary to apply these standards, because they do require judgment. Okay, so many people, particularly from jurisdictions that come from a legal environment where you're told everything you have to do and everything that you must not do, and everything is just left or right, right or wrong. Okay, IFRS is not so much like that. Okay, IFRS is designed to operate across all legal systems in the world. So it has to be more principle-based. And to understand principle-based standards and make the judgments that are necessary to apply them, okay, you have to understand the principles and what economics those principles are trying to reflect, and understand it is not always all of the economics. Okay, so sometimes it's just telling you a little bit of the economics, not all of the economics. So to make the judgments, if it's all of the economics, like fair value, that's easy. Okay, you just have to visualize all the economics. When it's some of the economics, that's more difficult, because you have to be able to capture the economics that is being captured and not capture the economics that is not being captured. Okay, so I think it's harder to do things like cost model accounting. It is harder to do value in use than it is to do fair value. Because fair value, I understand exactly what it is that I'm trying to do. With these other things, it's not so clear. Okay, and through the course of this workshop, we will go through some of those. But you have to make judgments about both. So you have to understand both. And you have to understand that the judgments are different, and we'll get to it today. The judgments are different. The perspective is different for an entity-specific measurement compared to a market measurement. So when you're doing recoverable amount impairment testing, which we'll get to later today, there are two measures: fair value less cost to sell and value in use. Value in use is entity-specific. Fair value is market view. Okay, the inputs to calculate those two are very different. You can get very different answers. The judgments are very different. Okay, and we'll go through some examples comparing the two and say, you know, do you include this or do you exclude it when you're looking at value in use? Do you include it or do you exclude it when you're looking at fair value? Okay, and we'll look at some other examples, in particular where the UK regulator has, and the South African regulator for that matter, have regulated companies on things like fair value measurement, where they have made companies restate their financials. And it's clear from what the company and their auditors were doing that neither the company nor the auditors understood what fair value measurement is. And therefore, they could just look, read the financial statement, say, what model have you used? What were the inputs to the model that you've used? Okay, you're not calculating fair value. Go restate your financials. Okay, and there's one case we'll look at where the company had to restate their financial statements twice, not once, for the same fair value measurement. Calculate fair value, they read it, say, that's not fair value, go restate your financials. Come back with a new number. What model did you use? What? No, still not fair value. Go restate your financial statements. So if you don't understand what it is that you are measuring, you will not be able to make the judgments and estimates to measure that thing. So you have to understand the perspective. Is it market perspective? Is it entity-specific perspective? Okay, and by the end of today, you will understand that. Okay, so if you don't understand it already, that's fine. Okay, but it's interesting, and it's not so hard. It's not so hard if you understand from the foundation up. The problem is too many people try to learn IFRS from, here's this thick book, I'll just read it all and try and understand from the top down. Okay, it's impossible. You can't understand from the top down. You have to understand from the bottom up. In fact, we'll look at a case as well in today where ESMA, the collection of European securities exchanges, like 10 years ago, wrote a letter to the IASB and said, we can't tell the difference between changes in accounting policies and changes in estimates. And I was working at the IASB when that letter arrived, and I read this letter, and I didn't know whether I should laugh or cry that all of Europe does not know the difference between a change in policy, okay, and a change in estimate. And the problem is they've just read the words top down. They understand now, it's different now, but 10 years ago, they didn't understand. It's not difficult. They did not understand because they said, it's a book, I can read the book and I can do it. No, you can't. You need to understand the perspective in each of those things. And I lecture at university, and my university students cannot believe that the whole of the European Union didn't know how to do this, because I teach them from bottom up, not top down. So in a few lectures, you can get people bottom up. Okay, why are we trying to do it top down? That's crazy. Okay, that's trying to make your life difficult is what it's trying to do. Okay, but if you come from, and I don't know all of your history, but if you come from a jurisdiction where it's always been top down, detail, right, wrong, you do this, okay, then IFRS is difficult to apply. You have to shift to the other way of looking at things, understand what it's trying to portray, and make the judgments that are necessary to portray that. Okay, so I'm sure you will enjoy some of the, I know I enjoy them, so I know you will enjoy them too, some of the exercises that we're going to do. Okay, so it's pointless me teaching you every requirement in IFRS and not how to apply any of them, because you can just do a word search for the requirements. So teaching you the requirements is a waste of your time and it's a waste of my time. And I don't like wasting your time or my time. Okay, so we're going to be doing lots of little quizzes, okay, just to see that we understand all the time. Okay, And don't worry about whether you get it right or wrong. I don't care whether you get it right or wrong. Okay, so if you get it right, it just means I haven't taught you anything today. If you get it wrong, and then you can get it right by the end of the day, then you've learned a lot. That's great. Okay, so it's a safe space. Okay, okay, just participate. Okay, so today's morning presentation, we're going to focus on presentation of financial statements, including the cash flow statement. I think it was yesterday the ISB announced they're going to do a project on cash flow statements. Okay, so cash flow statements, the rules are going to change. The rules have changed recently. Daryl spoke to you yesterday about IFRS, what was it, 18. When IFRS 18 came out, there were some changes to the cash flow statement. Okay, there were some crazy things in IFRS. You just had free choice between some things being operating or financing. They're clearly financing. Okay, the Americans have always treated them as financing because they are financing. But IFRS said you can choose whether they're operating or financing. So those choices have gone away. Okay, now they are financing. Why? Well, because they are financing. So it makes sense that they would be financing, for example. Okay, but we'll go through a few on the cash flow statement. Okay, we'll look at non-financial assets and we'll look at non-financial liabilities. Daryl on Friday afternoon will do financial assets and financial liabilities with you. So Daryl, he's a director of a bank, he's a director of an insurance company. He implemented IAS 39, the first bank. And so Daryl has tons of practical experience, particularly with financial instruments. Okay, so he's the man to teach you that. Okay. Business combinations and today, and then we will look at disclosure. There's some other topics, as you know, from the program that we're going to come back and have a look at. Okay, so the regulators that I follow are on the slide here. Look at the things. So a low number like 1 means that is the most prevalent mistake that the regulators have found in IFRS financial statements in that period. So if you're looking at the UK, the biggest problem that they found in 2023 and 2024 financial statements is impairment of assets. They think people aren't doing impairment of assets properly. So we're going to spend some time on impairment of assets. They're not doing it properly in the UK. They're probably not doing it properly in South Africa. They're probably not doing it properly in Germany. They're probably not doing it properly in North Macedonia. Okay, so these problems are pervasive. They are not country specific. Okay, or most of them are pervasive. So the biggest problem that the UK is finding is people are not doing impairment of non-financial assets properly. Okay, so recoverable amounts, people don't know how to do that properly or aren't doing it properly. Okay, so we need to iron that out a bit. Cash flow statements, the second biggest problem they're finding in the UK, people don't know how to do cash flow statements. Cash flows, isn't that just money that goes in your bank account and out your bank account? How can that be so hard? Okay, and South Africa, the third biggest problem that they're finding is cash flows. Okay, so people aren't doing cash flow statements properly. Okay, and then financial instruments, Daryl will take you through. Revenue, Daryl will take you through. Presentation of financial statements in South Africa, this is the biggest problem that they're finding. Okay, people don't present properly their financial statements. So in this session today, we're going to go through presentation. Judgments and estimates. Okay, the disclosure is about your most significant judgments and your most significant estimates, not done properly. Okay, so we're going to focus a little bit on those. Income taxes, I've got a separate session with you tomorrow. And fair value measurement, not such a big problem in the UK, sort of 9th, 10th biggest problem that they're finding. Okay, because they have regulated it. Now people in the UK understand how to calculate fair value. Okay, so South Africa, it's still relatively high. It's coming up about, what is it, 3rd or 4th biggest problem that they are running into still. Okay, climate related is something new. Okay, you're already required to disclose climate related things in your financial statements. Okay, so we're going to have a look at those as my session on Friday morning. I'll look at climate with you. And then there's some other things that the FRC and the JSE and ESMA have been looking at as well. So we'll cover some of those as well. But most of them fall into the categories that we have listed above. Okay, so in preparing for this session, this is what I had a look at. I looked at what is the recent regulation by the UK FRC, what is the recent regulation by the Johannesburg Stock Exchange, okay, and what is the recent published regulations that have come from ESMA, where they're regulating. So ESMA is the overall body of stock exchanges for Europe. Okay, so those are the latest informations that we have of where people are experiencing difficulties. Okay, so coming to presentation of financial statements, this is a big issue in some jurisdictions. So in South Africa, they're saying it's the single biggest problem that they're finding is people are not presenting their financial statements properly. Okay, so what are the kinds of problems in particular that they're finding? People aren't doing their accounting policies properly. You're not writing entity-specific accounting policies. You're just saying what the standard says. People know what the standard says before they read your financial statements. Your accounting policies are supposed to be entity-specific. They're supposed to explain how you in your company make the judgments, if you like, to meet the requirement and the standard. They shouldn't just be repeating what the standard says. Okay, and it's particularly acute where there are unusual transactions. Okay, so if you have unusual transactions or your accounting treatment is a little bit unusual, then we need to understand why that is the case at an entity-specific level. Okay, so this paragraph 31 of IAS 1 is the one that the IASB, the standard setter, is saying you're already required to do climate-related disclosures, because paragraph 31 of IAS 1 says if there's anything else that you need to know that isn't explicitly specified in IFRS to understand these financial statements, it has to be disclosed. And there's an exposure draft out now where they're adding examples to IFRS. And these examples are, many of them are coming back to cite paragraph 31 of IAS 1. So because it's principle-based accounting standards, they don't want to try and envisage every single thing that might occur in the future when they write the standards. So climate-related issues we didn't worry about a few years ago. Now we worry about them. So users of financial statements are worrying about them. So this paragraph says, if users are worrying about them, then you should be telling them something about them in your company if it's material to your company. Okay, so it's there to catch things that weren't envisaged at the time the standard was written. Okay, so once, when a preparer has prepared their financial statements using IFRS, they're supposed to then take a step back before they publish it and look at it and say, is there anything else I need to disclose? Because I don't have a fair presentation until I've done this. Is there anything else I need to disclose so that people understand my financial position, my financial performance, even though there is no explicit, you shall disclose this in IFRS? That's paragraph 31. Okay, regulators are now citing 31. Standard setters are citing 31. They're saying, why aren't you making more climate-related disclosures? Paragraph 31 is clearly written envisaging that type of scenario. Something becomes important that wasn't previously important. So it's important to your users. You should be telling them about it. Okay. So going concern, where there is significant uncertainties about your ability to continue as a going concern, there are specific disclosures that need to be made. So we've just been through a pandemic, and in the pandemic, you really saw some companies beginning to make good disclosures in that space. If you look at, for example, IAG, the airline, British Airways, Iberia, okay, and you look at the disclosures they made during the pandemic, maybe not the first year, but the second year of the pandemic, those disclosures were getting very good. If you look back, 15 years ago to some of these disclosures when Austrian Airlines was getting acquired by Lufthansa, And they said in their financial statements, we're getting acquired by Lufthansa. Okay, it has to go through regulatory approval. There's nobody else that wants to buy us. If this doesn't get regulatory approval, bye-bye money. Okay, you're losing your money if you're investing it. So buy a share now, understand when you buy that share, okay, there might be no Austrian Airlines tomorrow. If there's no regulatory approval, there's no Austrian Airlines. Okay, so that's the type of disclosure that's expected here. Okay, so it's not, it looks as if I'm going bust, I might be able to get out of it. So the worst thing I can do is tell people, you have to tell people. Okay, so that's the disclosure we're looking at. Okay, and it's meant to be quite detailed disclosure. Okay, thankfully the pandemic's over. Okay, but we'll have new problems. Okay, so when those new problems come, or if they haven't come already, okay, you have to think about that when you're making those disclosures. Okay, and then consistency between different notes. Okay, so what you're saying in one note to your financial statements, when I read another note somewhere else, it shouldn't look as if it's contradicting that note. Okay, so regulators are watching for this. Okay, and they're saying, you know, and they'll even look outside your financial statements, elsewhere in your annual report. Okay, particularly with climate-related issues. You write long stories about climate outside, you know, the front half, okay, which isn't audited. And then in your financial statements, there's nothing. Why? If it's so important that you're filling half of the outside the financial statement in your annual report with it, then why aren't I seeing anything in your financial statements? Okay, so you can see the kind of thought process that's going there. Okay, personally, these are the first disclosures that I look at when I look at a set of financial statements. So you're required to disclose your key sources of estimation uncertainty. What are the most sensitive estimates you have in your financial statements? Okay, so paragraph 125 to 129 of IAS 1. Okay, and then there's separate disclosures, which we'll look at separately, about the biggest judgments you made that didn't involve estimation uncertainty. Okay, so those two sets of disclosures, I think, are the most important disclosures in IFRS financial statements. They're the company telling the world, okay, the things in this set of financial statements that are most sensitive in terms of measurement are these things. The biggest judgments I had to make that didn't involve measurement, like is it an associate or is it a subsidiary? It was hard to decide. Your accounting is very different, isn't it, if it's an associate? So if that was a difficult judgment, and it will be a difficult judgment sometimes, then you need to tell people about it. Okay, so first, key sources of estimation uncertainty. This is where the numbers are most sensitive to change in the near term. Okay, so 12 months ahead, could the number turn out to be very different from what I've put in my financials? Okay, so here you can see this is the Johannesburg Stock Exchange saying the number of instances of non-compliance are increasing in this area, not decreasing. So people are getting worse at doing this disclosure, not better. Okay, so that's obviously not good. They need to start fining people, start taking, you know, if being nice doesn't work, then you go nasty, don't you? But you try nice first. Okay. Okay, so the particular areas that they are finding problems is the valuation of assets and liabilities. So if you have to value something, could be fair value measurement, for example, level 3 fair value measurement, the number's very soft. Okay, we expect to see if it's very sensitive and important to the financial statements. We expect to see maybe sensitivity analysis on reasonable possible changes in the most sensitive elements of that valuation. And if it's cost model accounting, it's even worse, because then you're doing impairment testing. And impairment testing of non-financial assets, recoverable amount impairment test, you have to calculate value in use, the entity-specific number, and you have to calculate fair value, the market number, less cost to sell. Okay, so you know, this valuation of assets and liabilities, don't think, okay, that must be just fair value measurement. No, all cost model assets are tested for impairment. So it is even bigger, the problem for cost model, than it is for fair value model. Okay, because you've got two calculations for cost model impairments. You've got value in use, the entity specific, and you've got fair value less cost to sell. Okay, so impairment of assets is a big problem. People do not do this well enough. They're saying the disclosures aren't good enough in South Africa, and they're saying the disclosures and the calculations aren't good enough in the UK. Okay, so this is big problem in financial reporting. Okay, and the same for provision for bad debt. So expected credit loss. I think I'm correct in saying you're doing IAS 39 in North Macedonia, is that right? Okay, so when you go to IFRS 9, the bad debt provisioning changes from incurred loss model to expected loss model. Okay, your problems won't go away. Okay, both involve lots of judgments and estimates. Okay, so just different judgments and estimates. Okay, so when you're looking at the disclosures you make about these most sensitive estimates that you have made, the disclosures are supposed to be helping users of your financial statements understand the key sources of estimation uncertainty. So it's not just what's the minimum that I can disclose. You're supposed to be making disclosures that help people understand those uncertainties and the degree of uncertainty. So the types of things you're expecting to see, what is the nature of the uncertainty? Sensitivity analysis. Sensitivity analysis isn't done just 1% up, 1% down. The sensitivity range is supposed to be on what is a reasonable possible change in the next 12 months. So you're not supposed to be using 1% up or down. You're supposed to be saying, what's a reasonable possible change up? What's a reasonable possible change down? Not a worst case scenario, just what is the reasonable possible change in the next 12 months on each of those inputs? Okay, so the regulators look at this and say, most of you aren't doing sensitivity analysis or equivalent disclosures. And those that are, you're not using reasonable possible change. You're just using 1% up, 1% down. That doesn't help me. I need to know what is the reasonable possible change. Okay, so you need improvement in that area. And then you're supposed to say, what is the expected resolution? Okay, so, it could be a court case. Well, the court will decide. It could be, I call it a negotiation with a regulator in terms of the penalty that you might get for something. So, how is that expected to resolve, for example? Okay, and changes to past assumptions, because some of these things drag on for many years. Volkswagen is still now disclosing about the Dieselgate emissions, aren't they? Okay, Dieselgate broke, what, a decade ago now? Okay, so these things go on for a long time. They're not once-off events typically. Okay, so you can see if you had assumptions last year and your assumptions are different this year, you're supposed to be telling people why your assumptions have changed. We expect your assumptions will change. So if I'm reviewing your financial statements and there's no change in your assumptions, I'm skeptical, because over time your assumptions are likely to change. Okay, you get new information, don't you? So IFRS is soft numbers. It is not hard numbers. Therefore, we expect to see lots of changes in estimates. It's expected. You can't perfectly forecast the future. So if it's an estimate, economics changes, your estimate should be different next year. Your range of reasonable possible change is likely different next year. Okay, so you need to be reconsidering these things every time. And if they're the most important judgments you're making, you should be telling people about those. Okay. Then there's what some people think is the get out of jail for free card. Okay, which basically paragraph 131 says, look, if it's impossible, impracticable means impossible. It doesn't mean hard. Okay, so impracticable says, we don't care if it's hard, you have to do it. Okay, but if it's impossible, then you don't have to do it. But instead, what you have to do is disclose all the information that you have that leads you to conclude that it is impossible to do. Okay, and we'll see the Johannesburg Stock Exchange regulating paragraph 131. People saying, I can't disclose this information, it's too hard. No get out of jail for free card. Okay, this is what you should be disclosing on the fact pattern that you've given us. Okay, and we'll look at that case in a minute. So I'm just giving you the information, the knowledge that we need to make the judgments that we're going to be making in a minute. Okay. Okay, so here's our first example. So you measuring fair value, and it's a subjective matter. So it's not level 1, it's not trading in an active market, which is quite easy to do. Okay, so this is a subjective, probably level 3 fair value measurement. The problem that the regulators are seeing is boilerplate disclosures. So people aren't telling you about their entity-specific measurement at level 3. They're trying just to write some, we go to the Big Four and we find their illustrative financial statements and we look at what they said about sensitivity and we just cut and paste into our, no, not good enough. Okay, so it has to be entity-specific. It has to be specific to your organization. And obviously COVID-19, there are now wars in the world. There's all sorts of things going on that are making these disclosures more sensitive. Okay. Okay, so here we have an example where an issuer is expecting changes in their production capacity to have a significant impact on their recoverable amount impairment test. Okay, so they're testing non-financial assets for impairment. The non-financial asset impairment test is recoverable amounts. It's the higher of value in use, the entity-specific measure, and fair value less cost to sell. They're saying, look, we expect changes in production capacity will have a significant impact, could make our impairment a lot bigger or smaller. Okay. Okay, so they know that. They're telling you that somewhere in their financial statements, but they're not providing any sensitivity analysis. So it's just a throwaway comment. Well, changes in production capacity could make our impairment bigger or smaller. Okay, how's that helpful? Okay, so what's a reasonable possible change? What would the effect of that reasonable possible change be on your impairment? That's entity specific now, isn't it? Okay, so you can see what's lacking in these disclosures. Okay, and the regulators are picking up on it. They're not sending people to jail over this yet. They're just saying, look, you can do better next year. That's the place that they're at on this now. Okay, so they're saying what we would expect a company to disclose. Okay, this is a separate example, and this is quite common, where companies say, okay, one of the things that triggers an impairment test is if your net asset value, your assets minus your liabilities, okay, your accounting equity is bigger than your market capitalization. Okay, so the value of your shares trading on the stock exchange is lower than equity in your balance sheet, which means net assets, appear to be bigger in accounting than they are in economics. So that triggers an impairment test. Okay, so where that happens, okay, there's going to be some sensitivity in the disclosures that you make, okay, because we need to understand why this is the case. Why it would make sense to buy your company, break it up, and sell all the assets off. Okay, because there would be value created in doing that if your accounting numbers are right. So we're wondering if your accounting numbers are right. Therefore, we expect your impairment tests will be sensitive. Therefore, we expect better disclosure about your impairment tests when you're in this situation. Okay, so that's basically the logic that's flowing through what we are looking at here. Okay, so this regulator during COVID-19 is saying, well, some of these disclosures are completely missing. Some are incomplete. Okay, sensitivities are badly done. Okay, they're not using reasonable possible change. Okay, so that is the kind of disclosure that we are expecting to find in the financial statements. Okay, and I'm sure when you reflect on the financial statements you've looked at recently, you probably think this isn't being done properly. Okay, so yes, there's some words and we repeat the words in the standard and the accounting policy, and then where it's applied, we write some vague stuff. That is not what IFRS is asking you to do. IFRS is asking you to be entity specific. What is a reasonable possible change in the most sensitive inputs that you've got in these impairment tests? And what would the financial effect of that be on the impairment test? Okay, that is very specific. Okay, so that's the kind of level of information that we're looking at. Okay, so here we've got an example. And remember I said I'd show you where paragraph 131, which some people read as the get out of jail for free. Okay, it's too hard to do these disclosures, so I'm not going to do them. Okay, so here's the South African regulator regulating a company that's trying that. Okay, so the company is basically saying, you know, it is too difficult for us to assign probabilities to these different possible outcomes to do the sensitivity analysis, so we're not doing it. And that's all we're saying. And the South African regulator is coming back and they're not saying it's possible. They're saying it's highly unlikely that it's impossible. So they're going to challenge you on whether or not it's impossible. But on top of that, they're saying, but you did assess feasible scenarios. You did determine possible cash outflows or inflows. What you saying you couldn't do was apply probabilities to those cash flows. Okay, so now give us all the information in your financial statements about the cash flows that you forecasted, okay, and the future scenarios you've looked at, and then tell us why you can't measure the probability that you would apply to each of those scenarios. So tell us about the scenarios, tell us about the cash flows for each of those scenarios, okay, and we maybe accept you can't assign probabilities, but don't tell us I can't assign probabilities, therefore I'm not doing all the disclosures. Do you see that? The alternate disclosures are, if you go for alternate disclosures, the alternate disclosures should always be a lot more information than providing the required disclosure. So here the required disclosure is maybe to do something like a sensitivity analysis, reasonable possible change on the most sensitive inputs. Okay, you're saying you don't want to do that. Okay, now provide us with all the information in your financial statements so that we as users can try and make the adjustments ourselves. Okay, so they're not saying there's no circumstance in which you can apply paragraph 131. They think it's rare, so they're going to challenge you if you try use it. And if you use it, there's a lot of disclosure you have to make. The disclosure isn't, I can't assign probabilities, so I'm not giving you any of this information. That is not the IFRS requirement. Okay, so it's important to understand this. Okay. So is this feeling a little bit heavy for a, what are we, Wednesday morning? Okay, so here's a regulator saying this is better practice example. So this is the kind of disclosure we're expecting to see. Okay, so you can see what are they saying? You have given us your most sensitive assumptions, and you've given us, you know, ranges. This, you know, a reasonable possible change in the cash flows is 20%. A reasonable possible change in the discount rate is 1%. And then you're giving us sensitivity on those reasonable possible changes. This is the kind of disclosure, okay, that the regulators are looking for, because this is the kind of disclosure that is required by IFRS. Okay, and if you're not making that disclosure, you're falling short of the mark. Okay, so you can see here companies being regulated, being encouraged, being shown a picture of what better disclosure looks like and saying, this is the type of thing we think you should be coming to. Notice the regulator never says best disclosure. The regulator just says better disclosure. Okay, because there's always room for improvement, but this is just much better than what everybody else is doing at the minute. Okay, so, okay. The next category is most significant judgments unrelated to measurement uncertainty. So these are the big judgments that you've made that don't involve measurement, basically. You also need to tell people about those. And the regulators are watching this. They're saying, you know, we focus on this area. So this is paragraph 122 to 124 of IAS 1. Okay, and they're saying, you know, the kinds of things that we should be seeing here if it was difficult to determine your functional currency. I can imagine in North Macedonia, sometimes it must be difficult to determine, I'm guessing, for at least some businesses, whether your functional currency is the euro or whether your functional currency is the North Macedonian currency. For at least some businesses here, that is highly likely to be the case. So I did a workshop like this in Singapore, and functional currency in Singapore is a big thing. It's this little piece of land, which is a big economy because it is interacting with other economies. Their regulator regulates hard on functional currency determination. So functional currency determination can be sometimes difficult. Sometimes it's easy. I'm clearly North Macedonian currency. I'm clearly US dollar. I'm clearly euro functional currency, wherever I am in the world. But sometimes it's difficult to determine what your functional currency is. If it's difficult to determine what your functional currency is, then you should be making these disclosures. Okay. Okay, whether something is a subsidiary or not a subsidiary. Many times it's easy, sometimes it's difficult. It's not a rule. It's not, I own more than 50% of the voting rights, therefore it's a subsidiary. That is not IFRS. IFRS says you must determine whether you control. So that determination is sometimes difficult. Okay, and you'll see many companies saying, I own less than 50% of the voting rights, but I control. And that judgment is oftentimes a good, honest judgment. Okay, so and then where's the line between significant influence and control? Okay, so, you know, there are difficult judgments here that need to be made. Okay, when I buy assets in a business combination, is it a business combination or is it just the acquisition of assets? And it makes a big difference to the accounting. If it's business combination, any overpayment is goodwill. Okay, if it is not a business combination, then the full payment is the cost of the asset, isn't it? Okay, so it makes a big difference. It is sometimes difficult to judge whether some acquisitions are business combinations or just the acquisition of assets. And IFRS was clarified, or tried to be clarified in that space a little bit not so long ago. Okay, and then when you're doing your impairment testing, remember, it would be much easier just to do fair value accounting and tell the truth all the time, but that's not what the world wants. So we have to do impairment testing wherever we have a cost model for assets. So this value in use impairment test, this recoverable amount impairment test, is probably the most difficult thing in IFRS that there is to do. Okay, but we've chosen it because we want to use a cost model. That's fine. Then we have to do impairment testing. Okay, so in that impairment test, you have to allocate things to cash generating units. Okay, so cash generating units, the smallest collection of assets with which you can associate cash flows. Okay, so, and then we've got different rules for how you allocate goodwill to cash generating units or higher than cash generating units. Okay, so those allocations, the regulators are watching. They're saying, but elsewhere in your financial or outside your financial statements, you're spending a lot of time describing things in a way that is inconsistent with how you are doing cash generating units. We think there's something wrong with what you're doing. Okay, so they're looking at that information. Okay, and when do you meet the definition of a discontinued operation? Okay, so if you do become a discontinued operation, then it'll be a non-current asset held for sale, and then you stop depreciating, etc. Okay, so being entity specific in your judgments about that is important. Okay, so this regulator, the Johannesburg regulator, stock exchange regulator, said, you know, in this one round, 2018, where they focused on this, they found 6 instances, and they're not looking at that many financials. Okay, they found 6 instances in that round where they think what people were doing with paragraph 122, these big judgments, didn't add up. Okay, so in particular, they were looking at when revenue recognition is triggered, whether a business combination is in fact a business combination or just the acquisition of assets, whether, you know, you have an associate or you have a subsidiary in particular circumstances. and somebody moved to equity accounting when they were previously using fair value through profit or loss for an investment. Okay, so that could happen for a number of different reasons. One could be a change in accounting policy. Okay, if it's separate financial statements where you have a choice, if it's in consolidated financial statements, then you would have to say, I'm an investment entity to be using fair value. So there could be a judgment over whether I'm an investment entity or not, for example. Okay, and then common control transactions are always difficult. Okay, so those are the areas that they were finding particular problems with. And what are they looking for? They are looking for entity-specific, fact-specific discussions about these judgments. They're not looking for boilerplate disclosures. Okay, and when I review financial statements and I see somebody say, one of the big judgments we had to make was determining our functional currency, and the functional currency is the currency that cut and paste from IFRS, not good enough. Okay, it's not telling people just what your biggest judgments were. It's telling people how you made those at an entity-specific level that is important. Okay, so good, you identified that as a judgment, but your disclosures are totally useless about it. Okay, so you know the job is not just identifying the biggest judgment, it's telling people useful information about that specific judgment that you had to make in the context of your entity's facts and circumstances. Okay, so I think that's important. Okay. Okay, so we're going to start doing some exercises now, okay, because I think you can only listen for so long before you go to sleep, and I fear we're getting close to that point. So one of the big problems we see in financial statements is people correcting prior period errors or not correcting prior period errors, disguising prior period error correction as change in accounting policy. Okay, so just not doing this properly, frankly. That's one of the big problems that the regulators find. So this was the third biggest problem. The Johannesburg Stock Exchange regulator looked at this one year, 2019, and said, this is the third biggest problem we find. Okay, we expect there will be errors, things will go wrong. Okay, and where there are errors, you have to be transparent about the correction of those errors, particularly if they're material. If they're immaterial, frankly, we don't care about them. Okay, but if they're material, we care about them a lot. Okay. So we need transparency about these errors that have happened. Okay, and that's where the problem lies. Okay, so looking at their 2016, when they were looking at 2015 reports, okay, they were saying you're not transparent, you're labeling things as restatement without explaining whether they're correction of error or whether they are new accounting policies being applied retrospectively, not good enough. Okay. And you're not clearly labeling things as errors that are errors. And then you're even calling the correction of errors changes in accounting policies. I've seen that in quite a few sets of financial statements when I look at them. Okay, and you failed to explain and highlight the fact that there were material errors. Okay, so I don't know why everybody's so embarrassed to tell people about the mistakes they made. We're humans, we're going to make some mistakes. Okay, so mistakes are going to happen. Where they happen, the best thing you can do in life is own up to your mistakes. Retrospectively, if it's material, restate your financial statements and carry on. Everybody trusts you when you do that. You start hiding it, I don't trust you. You start trying to say, I didn't make an error, it's a change in policy, or being obsequious about which one, I don't trust you. I'm not going to invest in your company. If you tell me, yes, we're human, we made an error, we're sorry, okay, we've corrected it retrospectively, you're investable again. Okay, if you're dishonest, you're not investable. That's basically what it comes down to. Okay, and you tell very quickly when you're reading financial statements whether the people are honest or dishonest. Okay. Okay. So looking at this one, an issuer determined using percentage of net assets materiality. Okay, so entities determine materiality, auditors determine materiality. Why is this important when we're discussing errors? If it's a material prior period error, we retrospectively restate. If it's not material, we can just correct it in the current year. Frankly, we don't care if you correct it even, because if it's not material, nobody cares. IFRS is explicit. You do not have to apply your accounting policy to immaterial items. So materiality assessments are pervasive to everything that we do in IFRS. Okay, and we're going to do some materiality judgments now with you. Okay, so we're going to do them together. Okay, so in this particular case, the company and its auditors thought net asset value was an appropriate method for working out a quantitative level for which they were going to use to determine materiality. They also considered some qualitative aspects because materiality is not just quantitative. Materiality is, could it reasonably be expected to affect a user's decision? And IFRS is clear that involves both quantitative and qualitative assessment. The assessment of those two things together determines whether or not it is material. So this is, accounting 101. The first thing you should be taught in IFRS is how to make materiality judgments. If you can't make materiality judgments, you can't do IFRS. Because IFRS only applies to material things to start with. We don't care what you do with immaterial things. And then it's also the threshold for particular disclosures, like whether or not you retrospectively restate for prior period errors. So they considered in the qualitative space, this was a very complex accounting matter. Why does that matter? Why does it matter if it's a complex accounting matter or not? Surely we're not pretending we don't have to do, it's not material because it's complex. Okay, go to jail, go straight to jail. Okay, complexity is not a reason not to do something. Okay, your job in accounting is to explain the complexity in a way that people can digest. It's not to ignore it because it's complex. Okay, that doesn't make any sense. Okay, and there's no evidence of intention to misstate. Yes, that could affect materiality. If there's fraud, it's more likely to be material than if there's not fraud. So this is an honest mistake, shall we call it. Okay, so that's the point they're trying to make in 2 bullet points beneath that. Okay. Okay, so in the year we discovered the error, okay, we corrected it, but we corrected it prospectively. So our judgment was it wasn't material. That's what the what the company has done in its financial statements. By correcting prospectively, it hasn't restated the prior period financials. So it's saying it was not material on the basis of its assessment. Okay. And then the regulator looks at this and says, hold on, but you've done prospective correction, and the prospective correction has caused your profit before tax this year to be different from the facts by 38%. So your trend in profits is getting distorted. So if you look only at the year when the error occurred and do your full materiality assessment on the year in which the error happened, maybe it wasn't quantitatively material in that year. But if you do the adjustment in this year and the adjustment messes up the numbers for this year, then the Johannesburg Stock Exchange regulator is saying it's material. So they're saying you don't just consider materiality of the year in which it occurred, you consider the effects of not retrospectively restating on current year profits. Because remember, some of these things snowball over many years, don't they? So it could be 5% of profit for each of the previous 10 years. So if profits remained even, then it would be, what, 50% of profits for this year. So it's material effect on this year's profit if I adjust in this year. Okay, and that's the point the regulator's making. The regulator's saying, okay, so does that make it material or is it immaterial? That's the question that we're going to have to answer now. So, is it material or isn't it material? Okay, so in previous years, it was below the quantitative materiality threshold. And in the current year, okay, by using all those 5% which were below material, rolling them all in and correcting it prospectively in this year, we're misstating our profits this year by 38%. Okay, so we're going to run a quick poll on that. Material or not material? Okay, so you can discuss with the person next to you. Okay, see what they think. So do you agree with the regulator or do you agree with the company? The regulator is saying this is material, okay, and the company is saying it's not material. Okay, so let's take, if we close the poll. Yeah, oh yes, please, always. Thank you. Sorry, we'll just leave it open for a second so that people online can log in what they think. Sorry, I should have warned you. Yes. Okay, so we're getting a lot of yeses and a few nos. And in the room, who says yes, it is material? Okay, who says no, it's not material? Okay, so why do companies do this all the time? Okay, because they're wrong. Okay, so the consensus always when I do this one is yes, it's material. Okay, but how many financial statements have you seen where the full assessment is done on the prior year and no thought is given to the effect on the current year? Okay, but what is material? Could it reasonably be expected to affect a user's decision? Okay, does that make sense? Okay, so we can close that one out. Okay, so then looking at what the regulator had to say about that, okay, you can see that the regulator is saying, sorry, I think we've gone slightly out of sync. Okay, so you can see what the regulator is saying is, yes, it's material, the company is wrong, so the regulator agrees with everybody in this room, and they're saying, you know, you have distorted your trend in profits, and the trend in profits is material to users. Okay, so it seems fairly obvious. Materiality is not difficult. Okay, we should get it right almost every time we do it. Okay, but out there it seems to go wrong for some reason that I don't understand. Okay, so I'm hopeful all of the ones we will do with you, you will make the right judgment, because if you understand what the judgment is you're trying to make, you sometimes wonder why the company made a different judgment. Okay, and they're going to get increasingly complex as we go. Okay, so the next one is to do with things that are recorded in fair value OCI. Okay, so if the change in the fair value of something, this is a financial asset, it's an equity instrument you invested in, you're doing fair value, but you're putting change in fair value in other comprehensive income rather than profit or loss. And the management makes a mistake, they count fair value twice. So they've doubled the number in the balance sheet. So they have doubled the number in OCI as income. So they have overstated income, they've overstated asset. The amount is big, it's bigger than the quantitative materiality threshold that they've set, but it's in OCI, okay, other comprehensive income. So they're saying, but nobody cares about other comprehensive income. Everybody watches profit or loss. Profit or loss goes into earnings per share, not other comprehensive income. Okay, so it's not material. Okay, so now we're going to take a vote again. So if we open it again, is it material or is it not material? What do you think? Okay, you can discuss with the person next to you whilst they're voting online. Is it material or is it not material? Okay, shall we take a vote in the room just whilst they're finishing online? So online, it seems most people are going for yes, it's material. In the room, yes, it's material. No, it's not material. Okay, a few, no, not material. So a few maybe are not material, both in the room and outside. Okay, so why do we put some things in OCI? What's the logic for putting, what is the standard setter thinking when they let you put things outside of earnings per share in OCI? Why? Why doesn't everything just go in profit or loss? Daryl was a standard setter. You can quiz him about this when he comes back. Give him a hard time in the afternoon. Okay, so why? Is there logic in having OCI? No, there's no logic. Okay, it's just when you come to set standards and you say, let's put fair value in the balance sheet, or let's put some relevant number in the balance sheet, people say, oh, but that makes my income statement go up and down horribly, so I don't like the volatility in my income statement. Okay, well, let's put it in OCI. Okay, then everybody's happy. Okay, for everything that is in OCI, there is something just like it that goes in profit or loss. Why did General Motors go bankrupt? Okay, because they made pension promises, medical promises. All those changes go in OCI, don't they? Okay, so don't ignore OCI. Okay, it's just like profit or loss. It's just a practical expedient in the standard setting process. And then we had a Dutch politician as the head of the ISB who thought he would write the logic for what OCI is. Good luck. There's no logic other than it's a practical expedient in the standard setting process. Okay, we can close that one out. Okay. Okay, so you can see materiality judgments aren't so hard. I'm not surprised. If you're doing IFRS, you're doing materiality judgments all the time. So this shouldn't be difficult to you. Okay, so the next one is very similar. It's the same issue, but now it was from a regulatory ruling. So here you have a regulator. It is a pension asset. The funded portion of the pension asset is overstated. So it's exactly like the previous example, except it's a pension, not a... So the change in fair value is going into OCI. So OCI is overstated. Assets, or in this case, liabilities are understated rather than assets being overstated in effect. Okay, so is it material? Yes, it's material. It's the same question as the previous one, just a different thing that goes in OCI. So clearly that one would be material. Okay, now here's an interesting one. So this is actually a US company, Kraft Heinz. And Warren Buffett, one of the richest people in the world, his company has significant influence over this company. Okay, so this company says, gets a subpoena from the US SEC, and the US SEC, who are proper regulators, they may be less kind than some of the other regulators I've been describing. Okay, says, we think there's funny business going on with your accounting for kickback discounts from suppliers. So kickback sounds all, oh, it must be dishonest. There's nothing, it's just multi-period volume rebates. Okay, so there's nothing shady about having multi-period volume rebates. They're there to encourage people to buy higher quantities from you. Okay, so there's nothing wrong economically with them. But because they cross multiple periods, it becomes difficult to say. So if the agreement is for every item that Kraft Heinz buys from you, so you are all the suppliers, I have an agreement with all of you as suppliers. When you sell me something, you're going to charge me 10 for it. That's list price. But if I go over 1 million items in the next 3 years, then you're going to refund me one of the 10. So then I'm going to have in effect paid 9, not 10. And if I go over 2 million, you'll refund me another 50 cents. Okay, so then my cost is going to go down to 8.5, isn't it? But I'm taking these raw materials, turning them into finished goods and selling the finished goods long before we know whether I'm paying 8.5, 9, or 10. You with me? So in the meantime, I've had to account for what? Inventory and cost of sales, haven't I? Okay, how does the inventory standard tell you to deal with multi-period rebates, volume discounts? You must adjust for them. But does it tell you how? No, it doesn't tell you how in IFRS anyway. Okay, so it's telling you, okay, you must adjust, you mustn't use 10, you must use some other number, but what number must you use? Good luck. Okay, we'll see you next year. Okay, so they're not helping you sort out the problem. So if this was IFRS, this is US GAAP, not IFRS. So if it's IFRS and you're the company, you Kraft Heinz, or you the auditor of the company, how do you work out what to do? What does IFRS say you do when IFRS doesn't tell you what to do? Paragraphs 10 to 12 of IAS 8, what we sometimes call the IAS 8 hierarchy. Okay, so if that big book doesn't tell you how to do something, or it's told you to do something, but not how to do the something it's told you to do, okay, then you go look in that book for something that's similar and related. Okay, so what do you think is similar and related? So can you find any accounting that's specified for anything similar and related? What do you think? There's a lot of things that are similar and related. Okay, so it's variable contractual consideration, isn't it? There's a contract, and we don't know how much we're going to pay under the contract. Okay, so what contracts is variable contractual consideration specified for? Okay, so you could go to IFRS 18, which I believe IFRS 15, which you're not yet doing, I believe, in North Macedonia, but revenue from contracts with customers specifies highly probable as the threshold. So the person selling to you must recognize 8.5 definitely, 9 if it's highly probable they will never have to, pay back the 5, and 10 if it's highly probable they will never pay back the 1. So highly probable. What does highly probable mean? Significantly more likely than not. Okay, I don't know why standards are written this way. Ask Daryl when he's here in the afternoon. Okay, significantly more likely than not. More likely than not is greater than 50% probability. So that's more likely than not. This is significantly more likely than not. So it's higher, isn't it? So when I'm doing it academically with my students, I just say, let's just visualize 75%. Okay, but the standard is not saying 75%. Okay, but that would be significantly more likely than not. Okay, so that line is not such a bright line, is it? Okay, so it's a little bit squidgy. Okay, so you can see there's some challenge. Okay, and the UK regulator suggested you might go there to have a look. Okay, why? There are other contracts. I mean, is lessee accounting symmetrical with lessor accounting? No. So why should I be looking for my guidance from a contract to sell rather than a contract to buy? No, I would argue with the UK regulator. No, I can go look elsewhere. I can get better accounting if I go to IFRS 9. I can get better accounting if I go to IFRS 3, where they specify fair value. That would reflect all of the economics. That would be better in my view. So if I want better accounting, I'm going to analogize to those standards. If I want less better accounting, I might analogize to the revenue standard. And there are other standards. You could look at the leases standard, which I'm looking at with you tomorrow. Okay, it's got a threshold reasonably certain. What is reasonably certain? Is it higher than highly probable or lower than highly probable? Reasonably certain? Higher? Okay, most people think it's higher. Okay, so when I'm doing this with my students Monday in class, I say, so do you all understand what being pregnant means? Okay, so what's being reasonably pregnant? Okay, it's nonsense, isn't it? What's being reasonably certain? It's nonsense. You're either certain or you're not certain. You can't be reasonably certain. That in the English language, that doesn't make sense. Good luck when you translate it into Macedonian language. Good luck. Okay, but we have some sympathy with the ISB for coming up with that, because they started with their exposure draft, their discussion paper was a really good idea. Okay, you would just account for the renewal option as a derivative at fair value and your lease. So if you had a 5-year lease with a 5-year renewal period, you would account for a 5-year lease and a derivative, which is the renewal option, because that's what it is in economics. But the world didn't want that. So then it was about option number 8 that they came up with. The world said, reasonably certain. Oh, great idea. What is that? No idea. Okay, so you can see the problem with standard setting. Okay, so in this case, once the subpoena had come to Kraft Heinz goes and does the internal investigation, like all companies doing something wrong seem to do, internal investigation, and they come back and they say, yes, we've been engaged in misconduct. This is from their financial statements. It's being honest, isn't it? We've been engaged in misconduct. Okay, well, not us. There's some rogue employees have been engaged in misconduct. Okay, so when we look at the number for these prior period errors, they say it is not quantitatively material. So it is beneath what they call their quantitative materiality threshold. But they say, okay, there's misconduct. People have been doing bad stuff. They've been fiddling with the numbers. Okay, so, you know, there's the statement. We don't think it's quantitatively material. Okay, so do you think it is material or it's not material? So it's beneath the quantitative materiality threshold. Do you know when the auditor comes, they set the quantitative material, it's beneath that number. And the effect on the current year is beneath that number. Is this material or is it not material? So should they retrospectively restate or should they correct in the current year? That's the question. Okay, so is it material? If it's material, retrospectively restate. Okay, so do you want to discuss that with the person next to you quickly whilst we just do the poll? Okay, so they're getting more difficult, aren't they? With a split between yes and no is getting closer now. Okay, because it is more difficult, isn't it? Okay, we've all had the auditors or being the auditor. Okay, we've all gone with the quantitative and the article clerk, when you send them out to do the audit, they come back with a list of unders and overs, don't they? And you compare it to total. So we've all played with quantitative materiality before. Okay, so in the room, who says, yes, it is material? Okay, and who says, no, it's not material? Okay, and who is just not playing this game? Okay, so it's a bit more split now, isn't it? Okay, it's more difficult. Quantitatively, not material. This company said qualitatively, because of those factors, it is material. It is material, and they retrospectively restated, and the US SEC didn't disagree with them. Okay, so it doesn't have to agree or disagree, it just observes what happened. It sent the subpoena, saw the action on the basis of the subpoena, saw the restated financial statements, didn't ask any more questions. Okay, you telling me you found that there's bad behavior? Okay, you've left no stone unturned. You know the usual story. Okay, we've rooted out the problem. Okay, so we are correcting retrospectively, even though it is beneath the quantitative materiality threshold. Their judgment is collectively quantitative and qualitative. It could reasonably be expected to affect a user's decision. Okay. Okay, so more of us agree than disagree. Okay, but it is a judgment, isn't it? Okay, but more of us are agreeing than disagreeing. Okay. Okay, and then we had a very similar case in the UK, a very similar case in the UK. Okay, so on this one, okay, the judgment was that it is material. Okay, the company judged that. Okay, and the regulator didn't disagree. Okay, then we had also these multi-period rebates with one of the biggest companies in the UK, Tesco's. I don't know if you get it here. It's just a supermarket where you go to buy groceries and things. Okay, and they had a very long, drawn-out story about the way they were fiddling the numbers, just like Kraft Heinz was, on these multi-period rebates. Okay, so it's exactly the same fact pattern. The problem was essentially in the UK, when online shopping came, we were very quick. If you've ever driven on a UK road, you understand why the UK changed very quickly from going to the store to having something delivered to you, because it's overcrowded, the roads. You don't want to spend your whole weekend driving to the supermarket. Okay, so it's much better that somebody brings the stuff to you. So the UK shifted very quickly from going to the superstore to buy our groceries to having our groceries delivered to us. Okay, so Tesco's business model had been very successful because they were the first to have superstores. And then they went around, land is scarce in the UK, buying up any land where anybody could build a superstore. Okay, so keeping the competition out of the superstore model as much as you can. And for decades, that gave them a competitive advantage. So it was a very good business model at the time they did it, but they didn't see the world changing. Okay, but then still wanted their bonus. Okay, so management still wants the bonus. So how can we stretch the profit a bit? Okay, we'll play with these accounting for the multi-period discounts. We'll pretend that it'll all turn out in the end and we'll get our discounts. Okay, so that's basically what happened. Okay, so very similar fact pattern to Kraft Heinz, with one or two very big differences. Tesco fired the management that had made the errors. So on the watch of management where those errors, arguably fraud, was committed, okay, they fired the management and new management was appointed. So in the year the prior period error is fixed, you've got new management. Kraft Heinz didn't fire the old management. They kept the old management. Management just said, look, bad things have happened on our watch, retrospectively restate, okay, everything will be fine going forward. Okay. So in the UK context as well, okay, so various regulators got involved, including the Serious Fraud Office. Okay, the grocery adjudicator, whoever they are, they fined Tesco over this. There was a deferred prosecution agreement. There were then institutional investors filing, saying, well, we bought shares at a higher price on false information, so we expect we will get compensation. And they were in time granted compensation for doing that. Okay, so you can see the usual thing that happens when bad things have happened ran through the system that you saw here. But if you looked at the quantitative materiality thresholds, so the year that this was discovered in was 2015. Okay, so that's the year when we're going to restate financial statements if we're going to restate, or prospectively make the adjustment if we're going to do it prospectively. So profit for 2014, okay, was 53 million. Okay, so the error, sorry, was 53 million in profit for 2014. But profit errors went back many years because this has been running for a number of years. So years before 2014 are overstated by 155 million, which means your balance sheet is overstated by 208 million. Okay, because it's the 2014 and years before adding up to 208 million overstatement in your balance sheet. The materiality threshold based on profit for 2014 was 150 million. Okay, so 53 million is smaller than 150 million. Okay, but the profit materiality threshold for 2015 was down to 50 million. So the year that we found the error in, we discovered the error in 2015. Okay, we fire old management, new management is in place when we're going to do 2015 financials. What does new management do when they walk into a new company? So typically, regulators observe, academics observe, when new management comes to a company that's had some problems, what do? Do they try overstate or understate profit the year they walk in? Okay, so what are they doing to achieve that? They need lots of expenses, don't they? Because all these expenses are old management's problem. They're not new management. New things are going to happen. So if I can write everything off, so if superstores were the problem, I want to impair my superstores, don't I? Okay, so if I impair my superstores, a massive amount, okay, like 2.4 billion or something was the impairment of the superstores in 2015. Okay. So that's going to make profit very small this year. It also means superstore depreciation going forward is going to be very small, isn't it? Which means I'm going to look good, aren't I? Okay, so it doesn't matter whether I'm a good manager or not. If I write everything off, then I'm going to look good, aren't I? Okay. So you can see what management incentive is. So to understand these things, you have to understand management incentive. Okay, so Kraft Heinz old management stays. These incentives aren't there. Tesco old management fired. Completely different set of incentives now for management. Okay, now they want to write everything off that they can write off. Okay, and they do that. If you look at some of the write-offs here, the second last bullet point, 4 billion write-off for the superstores. Okay, so which year does that write-off belong in? So they've put it in 2015. Do you agree with them? That's a big write-off, isn't it? Okay, so if they were incorrectly forecasting cash flows last year by overstating the volume rebates, then surely they were under-impairing in the previous year. And if their business model was wrong, superstores were no longer the right recipe for profitable supermarkets in the UK, then surely this didn't happen all in 2015. Okay, but that's not what Tesco's did. They showed that whole impairment in 2015. They didn't retrospectively restate the prior period error like Kraft Heinz did. They said it's not material, it's below the 150 million, so I'm writing it all off in this year. So what's happening to profit this year? They're driving profit down, aren't they? Why is profit down? Old management problems, we're cleaning up. How can you not look good next year now? Okay, it would be impossible not to look good next year. Okay, so you can understand management's incentives in what they're doing. As an auditor, you're going to go, no, no, no. As a regulator, you're going to go, no, 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 aren't you? Okay, does that make sense? And then what about fines? So what about, actually being fined for the bad things you've done? And then what about compensating those shareholders that bought your share at a higher price than they would otherwise have paid? Okay, and that 50 million, this 50 million that we've got on this slide here, okay, of the 53 million, that didn't include any possible penalties, didn't include any possible understatement of impairments, didn't include any compensation that could get paid to shareholders for things you've agreed you've done wrong. And you're saying this is not material, I'm correcting it prospectively because it'll make me look good the next year. Go to jail, go straight to jail. Okay, sell your shares. Warren Buffett sold his shares. He looked at this, he said, big mistake, I ever bought shares in this company, sell. Okay. Okay, so is it material? Yes, it's clearly material. Okay, did Tesco's treat it as material? No. Okay, that's not good, is it? Okay, I've never done this case study with anybody who said it's not material. Okay, so you understand when you're looking at quantitative, you're not just looking at quantitative what was put in the accounts. You're also considering quantitative what wasn't put in the accounts. The future fines that relate on past events, the future compensation that the court will decide that relates to the past events. So even on a quantitative basis, I don't understand why this is not material. Okay, this is just very bad example of bad behavior, I think. Okay. Okay, so the next thing we're going to do is, this comes from the letter I told you about that the collection of European regulators sent to the IASB, saying they can't tell the difference between changes in accounting policies and changes in estimates. So I was quite surprised when I saw this letter because I don't think it's particularly difficult. And perhaps more worrying for me was they didn't seem to consider that there could be errors. So before you look to even think about whether something is a change in estimate or a change in accounting policy, I think you should first consider whether it's an error. Okay, so in the context, we're going to look at this now. We're going to say, okay, we accept that there isn't an error. Okay, but the first step would always be, is there an error? Only once you have satisfied yourself there is not an error, only then would you consider whether you have a change in policy or you have a change in accounting estimate. So all of the ones on this slide are to do with fair value measurement. Okay, so all of them are saying, okay, we're trying to measure fair value, and for some reason we have changed either the model or the model inputs that we are using with that model in order to estimate fair value, and it's changing from one period to the next period. So last period in the first one, I was using Black-Scholes. Now I'm using Monte Carlo. It's just an option pricing model. Okay, is it an error? Well, why is it changed? Okay, there's probably an error here. Okay, but if there's no error, then is it a change in policy or is it a change in estimate? The second one, in calculating own credit risk effect on fair value, I was using credit default swap curve. Okay, but now I have a most recent issue of debt, so I can get better information from most recent issue of debt, or I can no longer access credit default swap curve. Okay, so for some reason I'm changing from one to the other. Okay, so if it's not an error, then it's changing because I've got better information to be able to use. The third one, it's working out probability of default. There's some change in the credit value adjustment I'm using. And the last one, last year I was using a market approach because I had information to use a market approach. I had a recent transaction price or something. And now this year, there's no transaction price. I still have to measure fair value. So now I'm discounting cash flows. I'm using an income approach. Okay, but I'm doing that because I don't have market information available to me. So I have to use an income approach. There's no alternative. It's what I have to do. Okay, so assuming that there's no error, the answer to all of these should be the same. It's either a change in estimate, that my number changes from last year to this year, or it's a change in policy. Okay, so think about what fair value measurement is. You're trying to estimate a price, and you're using whatever's available to you at that point in time to estimate the price. You're trying to maximize the use of observable inputs, for example. Okay. What is fair value? The price you expect. You're estimating a price the asset would sell at in a proper market at measurement date. Okay, so the way you're measuring fair value this period is different from the way you're measuring fair value next period. Either the model's changing or the model inputs are changing. They're all the same question. Okay, so why this didn't come as one question, why it's come as A to D, I still don't understand, because if you understood, there's only one issue to discuss here. Either the model's changing or the model inputs are changing. If you're saying it's not an error, then they're doing the right thing at both points in time, last year and this year. So is it a change in policy or is it a change in estimate? Okay, discuss with the person next to you and we can open the poll, Goran. It's just one. So I think it's either change in policy or change in estimate. So yeah, it's just one or two. Oh, it's a dead heat almost in the online group. Okay, so it's a bit split. Okay, so let's take a vote in the room. Who says it is, what was the first one? Change in policy. So who says it's change in policy? Okay, who says it's change in estimate? Okay, and a lot just are not going to say. It could be either. No, it's definitely one or the other. Okay, so do we know what we're trying to estimate when we're estimating fair value? We're trying to estimate the price at which it would sell in the market. And the way you estimate it is you don't have a policy that tells you how to estimate it. Okay, you have to use the model that market participants would use to measure, and you have to look through the eyes of the relevant market participants, and you have to maximize the use of observable inputs. So if any of those things change over time, you have to change with the market because you are trying to look through the market's eyes. Okay, so obviously in cases like if you've got a recent transaction that'll give you information you didn't have before, then that could cause you to move to the new information that you've got. Because if market participants have that new information, they're going to use it. Okay, so it's always going to be change in estimate. Your policy is fair value. How you measure policy depends on the information available at a point in time. It doesn't depend on your policy. You don't have a policy for how you measure fair value. No such thing. IFRS 13 says the way you measure fair value is you look through market participant eyes. What model would they be using? What inputs would they be using? That's how you measure fair value. So it'll change from one period to the next, depending on the available information. So you could have a share that's trading on a stock exchange actively, then you would have to take the price from the stock exchange. You couldn't say, no, I'm going to forecast cash flows, discount. No, go to jail, go straight to jail. You're not allowed to do that. Okay. You have to take the price from the market if it's trading actively in a market. So if a share wasn't trading and then started trading, you might have been using an income approach. Now you have to just take the price from the market, don't you? Okay, so you can see, depending on the information that's available to you in a particular period, the method, the valuation method that you use will change when you're measuring fair value. That's not a change in policy because you don't have a policy for how you measure fair value. IFRS 13 tells you how to measure fair value. And it tells you, you use the method market participants would use. You look through market participants' eyes to find the relevant inputs they'd be using. And that will change from one period to another, depending on the information available. What you strive to do is maximize the use of observable inputs. So if it trades in a market, you can't say, I'm going to ignore, the market's wrong. I'm going to come up with my own price. No, you can't do that. Okay. Okay. So that's that one. Okay, so now when you're thinking about whether something's a change in policy or you're thinking about whether something is a change in estimate, you're going to have policies where you have choice. So if you can choose a cost model or a revaluation model, that's clearly a choice. So your policy is one or the other. Lots of your accounting policies are going to describe things that aren't a policy per se. So if you think of depreciation, okay, if I change from, so I'm flying airplanes and I change from units of production, takeoff and landing cycles, because my airplane can only do so many takeoff and landing cycles. Then the government, let's just say the World Aviation Authority decides, okay, old airplanes are too polluting. Okay, so we're not going to let you fly any airplane more than for the next 3 years of the type of airplane that you've got. And there's no way, even if you flew it all the time, you were going to do all the takeoff and landing cycles that were left. You would change from takeoff and landing cycles to straight line depreciation, wouldn't you? Because it's time that's your restriction, not takeoff and landing cycles. The restriction's gone from takeoff and landing cycles. I was only allowed to do so many thousand takeoff and landing cycles. I intended to use them all. So I was depreciation, takeoff and landing cycles. Now that's no longer my restricting factor. I'm given 3 years. There's no way I can use up the remaining takeoff and landing cycles in 3 years. So now I'm straight line depreciation. Is that a change in policy or is that a change in estimate? Estimate. You see, you can do it now. Problem solved. Okay, it's not a choice. You have to determine the depreciation method that best reflects how you consume the service potential. So your policy might say, I'm using units of production. It might say I'm using straight line. Changing from one to the other is not a change in policy. It's a change in estimate. All your accounting policy is doing is it's telling people about the inputs, the factors you are using to determine how you consume the service potential of the item. Okay, and that's a surprise to some people. And US GAAP might be different. So when I speak to my US colleagues, they say, no, in US GAAP, we can choose. So I don't know how good my US colleagues are, whether that's true or not under US GAAP. Under IFRS, it's not true. Okay, under IFRS, you determine the depreciation method. You do not choose the depreciation method. Therefore, when you change from one to the other, it's a change in estimate, not a change in policy, even though it's written in your accounting policies. So don't think about accounting policies as if I change what I've written in my accounting policy, it's a change in accounting policy. Not necessarily. You could just be giving entity-specific information about how you apply the policy. The policy is the depreciation method must reflect how you consume the service potential of the asset. That can change from one period to the next. You see, this is understanding from the bottom up. It's easy now. Whenever you see a change in policy, change in estimate, you get it right. If you just read those standards, you would think it's a change in policy, not a change in estimate. You can't build a house from the roof down. You build a house from the foundation up. Okay, almost every country that starts applying IFRS starts to build from the roof down. No wonder it's a mess. Okay, you can't build that way. Okay. Okay, so the next thing we're going to do is go through some cash flow statements. Okay, so let's just think about this. So regulators are saying, those that are doing desktop reviews of financial statements are saying we're finding lots of problems in cash flow statements. There have been a couple of standard setting activities to fix this. And now the ISB said they're going to do a cash flow project, actually. So the way we do cash flows could change significantly in the future, but that's maybe 5-10 years time. So some small changes have been made now, but there's some big change that may or may not come in the future. So particularly if you're a bank, okay, the current cash flow statement, it's not telling you much about a bank's cash flows. Okay, so that's one thing that we probably going to argue in the UK that should be changed. The way a bank's cash flow should be done should be something different from what's currently required. Okay, but it's currently required, so you do what's currently required. Okay, so I suspect that's what we will do. We're starting a research project on that now ourselves. Okay, okay, so here we've got the South African Stock Exchange regulator. They're saying, you know, some companies, you can't even see if they're doing direct or indirect method. It's such a mess what they're doing in their cash flow. So some it's just a total mess. Okay, and for others, okay, so this is an interesting one, actually. So we'll do this one as a quiz. Okay, so an issuer, so somebody preparing financial statements and filing them with the stock exchange regulator, extinguished a loan by physically paying in gold. So they paid with gold. That's how they paid. Okay, how would you expect that to show up in the cash flow statement? Okay, so it was a loan that they extinguished by paying with gold. Okay, so what do we have here? Do we have an operating activity, an investing activity, a financing activity, nothing to do with cash flows, just some note disclosure, or does it depend on our accounting policy? Okay, so we'll open the poll and discuss in the room, see what you think in the room. Which one do you think? Okay, so discuss with the person next to you, see what they think. I actually think this is a reasonably difficult question, actually. It's not as easy as it sounds, I think. Okay, so how are we going online? I've forgotten what the alternatives are, but there's a range. Choice number 3 seems like the popular one. Okay, but we are all over the place, aren't we? Okay, so shall we take a vote in the room and see what people think? Okay, so who thought operating? Okay, who thought investing? Okay, who thought financing? Okay, who thought it's just note disclosure? There's no cash transferring hands. Okay, and who thought it depends on my accounting policy? Okay, so now we have a little bit of everything, don't we? Okay. Okay, so what did the regulator say? Okay, so the regulator, quite correctly in terms of IFRS, okay, says gold is a commodity. Gold is not cash or cash equivalent. So if you settle something with gold, okay, it's a non-cash transaction. So the disclosure people, you're the right people. Okay, but it's a little bit tricky because in some places, gold is considered legal tender, isn't it? So if gold is considered legal tender in your jurisdiction, then you think, but my jurisdiction is telling me it's money and IFRS is telling me it's not money. Okay, but if you look at IAS 39, IFRS 9, okay, they tell you that, you know, gold is not a cash or cash equivalent, it's a commodity. So it's very close, but it's not quite there. So in IFRS, we wouldn't treat that as a cash flow. So there's no cash flow, so it can't be in your cash flow statement. Okay, so it's just note disclosure. It's close though, isn't it? Okay. Okay, so that's the answer under IFRS. Okay, and the regulator knew it. Okay, so the regulator, if we turn that one off, the okay, so the regulator is coming back and saying exactly that. Okay, so the regulator is saying, okay, so note disclosure only. Okay, and that's consistent with how we think about gold in IFRS. But there's some states in the US where gold is legal tender. So in theory, you could go to the grocery store with gold and say, here's my gold, I'm taking my groceries. Okay, that's about as mad as arriving with Bitcoin, I think. So actually, if it was Bitcoin, would your answer be different? That's a good question. If it was Bitcoin, would your answer be different? Okay, there's an ad in the UK about the corner grocery store, and the person comes to pay and it says Bitcoin only. Okay, because it's saying how ridiculous the world can be sometimes. Okay, so so if this was Bitcoin, would your answer be different or would your answer be the same? Okay, so where does Bitcoin go in IFRS? Like Tesla owned a lot of Bitcoin. MicroStrategy owns Bitcoin. Okay, everybody wishes now they own Bitcoin because the price is the highest it's ever been. Okay, so for those people that are holding Bitcoin as a store of wealth, okay, so where in your balance sheet is your Bitcoin? If you're dealing in it, it will be inventory, but if you're holding it as a store in wealth, where would it be? Okay, this went to the interpretations committee about a year or two ago, and what did they decide? Quite rightly. Okay, intangible asset. Okay, because the intangible asset category is everything that doesn't fall into another asset category. It's the residual asset category. Okay, so it's intangible asset, isn't it? Okay. That's a bit rough, isn't it? Because you have to use cost model or revaluation model, not fair value model. Maybe intangible asset standards need some improvement. Okay, it's not quite fit for purpose. Okay, interesting though, isn't it? Okay, so would there be a cash flow if you paid in Bitcoin? No cash flow if you're paying with Bitcoin. If you are holding the Bitcoin as a store of wealth, it's like gold, it's the same. Okay. Okay, so which part of your consolidated cash flow statement is affected by a cash outflow when you buy back your own shares? Okay, so companies often buy back their own shares. Okay, they're happening in North Macedonia. Okay, so in the cash flow statement, when you buy back your own shares, where does that go? Operating, investing, financing, note disclosure only, or it depends on your accounting policy. This one, lots of people get wrong. You buying back your own shares. Okay, shall we run the poll? So you make a payment buying back your own shares. Where does that cash flow go? Operating, investing, financing, note disclosure. It depends on your policy. No. Okay, so what we're getting from the Zoom room, we're getting quite a mix. Okay, so a few people saying operating, more saying investing, most saying financing, but not a big majority. Okay, some saying non-cash, okay, and some saying it depends. You can do whatever you want. Just tell us what you're doing. Okay, that sounds like the accounting I see in many places. Okay, but it's not that answer. Okay, so in the room, what do you think? Who says operating, investing, financing? Okay, or what was the other one? Oh, just note disclosure. Okay, there's a cash flow. It can't be note disclosure, and it's not the last one. Okay, so slightly correct. The most people coming out, it's got to be financing. If a company issued its own shares, you would say that's financing. If they buy back their shares, they're just canceling the financing, aren't they? So it's all financing. Okay, but some people think I'm buying shares, so it's investing. It's not investing. Okay, it's clearly not investing. Okay, common mistake that regulators find. Okay, people treat this as investing cash flow. It's not investing. Okay, if you issued shares, you wouldn't say it's investing. When you cancel shares, if you buy back your shares, you are in essence canceling their claim against your assets. Okay, it's also financing, isn't it? Okay. Okay, so let's go on to the next one. Okay, sorry, just in case you missed, that was that one, wasn't it? Okay, so that's clearly financing, and you can see regulators seeing this problem, not investing. Okay, so now this is a slightly more interesting question. So entity B is wholly owned by entity A. So entity A is at the top, and it owns entity B. It tells entity B, go buy entity C. Entity C's only assets are shares in A. Entity B pays cash for entity C. Entity C's only asset is shares in A. Okay, so in the group cash flow statement, cash is going out. That cash outflow, is it operating, investing, financing, non-cash? Okay, what is it? What is it? What do you think? So cash is leaving the group because we're paying whoever owns C, we're buying those shares, but C's only asset is shares in A. Is it operating, investing, financing, non-cash? What do you think? Okay, so what do we have? We have operating, investing, because we're buying a new subsidiary. Is it? Investing? Is it? Is it? What are you investing in from a group perspective? Your own shares. Yeah. So who says C? You're just financing. You're just buying back your own shares. That's all you're getting is your own shares. You're paying money, and the thing you're getting is shares in you. That's just like buying treasury shares, isn't it? Same thing. From the group perspective, it's just financing. So cash is leaving the group. It's going to the people that used to own C. Okay, so cash is going, but what are you getting in exchange for the cash? Your own shares. From a group perspective, you're just getting your own shares. So that's financing. Okay, it sounds like investing. You want to say investing, you're buying another company. But in IFRS, you're never buying another company. You're just buying another whatever that company's got, aren't you? In the consolidated financial statements, you're not accounting for investments, you're accounting for the underlying assets, aren't you? Okay, so you're buying shares in yourself. That's what you're doing. That's treasury shares. Okay, does that make sense? So it's got to be financing. Does that make sense to everybody? Okay, so you can see that happened in South Africa. A company did that, said it's investing. Okay, big numbers. No, you're not investing. It's financing. Okay, so which part of the consolidated cash flow statement is affected by extinguishing the non-controlling interest? Okay, so a parent has a subsidiary. The parent owns, say, 75% of the subsidiary. So other people own the other 25%. Then the parent buys that other 25% out. Okay, so cash goes to extinguish the non-controlling interest. Operating, investing, financing, no cash, or it depends on your accounting policy. Which one do you think? Okay, so it's a close contest between investing and financing. Okay, so it's one of those two. So which one is it? Who says investing? You just can't resist the temptation, can you? Okay, because you're buying shares, aren't you? But in the group context, those shares just represent a claim against your subsidiary assets. So they're owners in your group. They're funding your group, aren't they? Okay, so when you buy them out, it is financing. It's the same as treasury shares. The treasury shares are here. The non-controlling interest is only in your subsidiary. But from the group perspective, they're owners, just like the people at the top are owners. They're owners in the subsidiary. The people at the top are owners in the parent and the subsidiary's assets. But it's always, we're accounting for all the assets and liabilities of the parent and the subsidiary, and these people are the owners, the non-controlling interest and the owners in the parent. Does that make sense to you? So it's the same question. We ask it just over and over again. Change the facts slightly. It's non-controlling interest. It's treasury shares. And people want investment. They want, okay. It's not investment. It's financing. Okay. Okay, so going to the next one if we can. Okay, so you can see, okay, it comes up in reality. Okay, so you see this happening quite a few times, actually. This is a very common one. Okay, so now, which part of the consolidated cash flow is affected by dividends paid to the non-controlling interest? Okay. Operating, investing, financing, okay, non-cash, okay, or it depends on your policy. Okay, so it's owners of the business, we're paying dividends to them. It's got to be financing. Okay, so it's got to be financing. Okay, so IFRS, old IFRS, which has now been changed, but still maybe the IFRS you're using, used to give you a choice between dividends paid, you can say it's operating or it's financing. Why did it ever say that? Isn't that just crazy? You're giving money back to owners and you're calling it operating. Has the world gone mad? Okay, but old IFRS allowed you to do things that were a little bit crazy. Okay, because it's a social science. We just agree what it is. And sometimes you're agreeing with crazy people in the world. Okay, so it's nothing new to us. There's new crazy, old crazy. We slowly wash out the old crazy, but there's new crazy. So there'll be new stuff that we have to iron out. Okay. Everybody happy. So you can see that these are real regulatory issues when people are reviewing desk-based review of financial statements. They're finding these things and saying, you're not applying IFRS, you're doing something else. Okay, it's not IFRS that you're doing. Okay, so which part of the consolidated cash flow is affected by cash paid to increase your interest in a subsidiary from 60% to 75%? So you own 60%. Now you're buying some more shares, you're going up to 75%. So you're paying for those extra shares in the subsidiary. Okay, where's that cash flow? Operating, investing, financing. Okay, clearly financing, isn't it? Okay, I don't know how many different ways I can ask you the same question, but the answer isn't going to change. It's financing, isn't it? Okay, so does that make sense to you? Okay, so yes, everybody's financing. Okay, perfect. Well done. Okay, so you've got it now. You just have to picture in your head when you're looking at consolidated financial statements, it's the assets and liabilities of the parent and the subsidiary. And the people that own the shares at the top are equity, and the non-controlling interest is equity. So any transaction with equity holders, you know, in their capacity as equity holders is financing. Dividends, buying out shares, buying back shares, issuing shares, anything. It's got to be financing, doesn't it? Okay, does that make sense? Okay, but it's a persistent problem. We're seeing this everywhere in the world. People want investing for financing cash flows. Okay, not right. Okay. Okay, so I think everybody's on top of that now. Okay, now a slightly different one. Okay, which part of the cash flow statement is affected by a cash outflow when you settle a cash settled share-based payment? Okay, so just in case, just understand the economics a bit better. You know, you get share options. So share options, the company usually pays you with a share. Okay, so you pay the strike price, they give you a share. A cash settled one is slightly different. You pay the strike price and they give you cash. Okay, but the amount of cash they give you depends on the share price on that day. So it's a cash settled share-based payment. So typically some bigger companies will have bonuses that are paid on using cash settled share-based payments. So instead of paying you with a share, they just pay you with cash, which is the difference between the market price of the share and the strike price in the option. Does that make sense to you? Okay, so there is a cash flow, they pay cash. Okay, so, you know, is this operating? Is it investing? Is it financing? Okay, we'll just think of those three options. There is a cash flow, so it's one of those three, and you don't get to choose. Okay, so it's an employee benefit, which is paid in the form of a cash settled share-based payment. What do you think? Okay, so let's take a vote. Operating, investing, financing. Okay, the pattern ends. Okay, this one isn't financing. Okay, you hear share-based and you think, okay, it must be finance. It's something to do with shares. Okay, it's a cash payment. It's just we determining the amount with reference to the value of our share. So this is an operating cash flow now. Okay, does that make sense to everybody? Okay, no shares are getting issued. If we issued shares, then it would be financing, wouldn't it? Not operating. But we're not issuing shares, we're just paying cash. Okay, so it's going to be operating. Everybody happy? Okay. Okay, so here's one that we could discuss tomorrow, but let's do it now. Okay, so on the last day of 2024, you enter into a lease for a new factory. You raise the right of use, so you put the factory, your right to use the factory in your balance sheet as a right of use asset, and you raise the fact you have to pay as a liability. So you're raising the asset and you're raising the liability, but you're not making any payments yet. The payments start next year. So in this year's financial statements, do we have operating, investing, financing, note disclosure, or it depends? What do you think? Okay, do you want to discuss with the person next to you quickly? Okay, shall we take a vote? Operating, investing, financing, note disclosure. Okay, note disclosure, there's no cash flow. Okay, you're just putting an asset and a liability in your books. There's no cash flow this year. Okay, so it's note disclosure. Okay, so those that got it wrong were probably thinking there is a cash flow and how would I classify the cash flow? Okay, okay. Okay, so you can see this happens. Okay, regulators have had to say no. Okay, so now let's go on to property, plant, and equipment as the next thing I wanted to discuss with you. Okay, so reclassifying can be tricky. So you've got something that's property, plant, and equipment, it becomes investment property, or investment property becomes inventory, or property, plant, and equipment becomes inventory, or inventory becomes investment property. So how you deal with those changes is quite difficult. And most of it is set out in IAS 40, the investment property standard, tells you how to deal with those changes. Okay. So you've got to be careful when you're reclassifying from one to the other, and you have to make sure that you should be reclassifying. Okay, I was doing, I think it was Bangladesh, I was doing like I'm doing here with you now, and the Institute had arranged the workshop, and the Institute were not accounting properly for one of their buildings. And I do the question, I didn't know the Institute was doing this, so I do the question, and the answer is not what the Institute is doing. Okay, and they were a little perplexed, shall I say, but it doesn't change the answer. The answer is, I'm sorry, you're doing it wrong. Go restate your financials. But it was quite entertaining. Okay. Okay, so you have to determine what are the criteria for making the change. Have you met the criteria? You make the change. You haven't met the criteria, you don't make the change. And then generally you look to IAS 40 will tell you how to deal with these changes. Okay, so you see confusing things like if something is owner occupied, okay, you're typically expecting it to be property, plant, and equipment, aren't you? Okay, if the building is owner occupied, it's typically property, plant, and equipment. Okay, so now you see owner occupied, but they're doing fair value accounting for it, and you think, what are they doing? Okay, so that's the kind of problem that you see. Okay, so here's an example that the regulator had to have a look at. You've got a group, it's a parent and two subsidiaries. Subsidiary A is renting a building to subsidiary B. So in subsidiary A's books, it's investment property. And in some subsidiary A's books, it's using fair value accounting. So it's accounting for its investment property at fair value. Now the consolidation is done, and the regulator is looking at the consolidated financial statements. So how must the group account for that property? Must it use a fair value model, a cost model, a revaluation model, or it depends? The subsidiary is using a fair value model. What model must the group use? Okay, because investment property, and the subsidiary has chosen to use the fair value model for investment property. But what does the group do? Okay, so the group is consolidating the parent and the two subsidiaries. In the consolidated financial statements, what must the group do? Okay, discuss with the person next to you. Okay, so I don't remember what the alternatives are, so we're not necessarily asking in the same order. Okay, but who says that they must use the cost model? Who says they must use the fair value model? Who says they must use the revaluation model? Who says it depends on their accounting policy? Okay, and for it depends on accounting policy, which accounting policy? So the property, plant, and equipment accounting policy, which will be cost model or revaluation model. Okay, that's the right answer. Well done. Okay, so from the group's perspective, it's owner-occupied property, isn't it? If you take the parent, the subsidiaries together and think of them as one, the fact that A is or B is renting it to C, okay, now A, B, and C are all one, aren't they? So we're occupying our own building, aren't we? So as soon as we're occupying our own building, you property, plant, and equipment. So in B's own books, it's investment property. So if B made B only financial statements, it would be investment property. But to the group, it's not investment property. To the group, it's owner-occupied. It's property, plant, and equipment. So then it depends on their accounting policy, cost model or revaluation model, depending what their model is, okay, their accounting policy is. Okay, interesting, isn't it? Okay, it's quite difficult. We ask you very quickly, think about this and give us the answer. Okay, but okay, it makes sense that you would get there. Everyone happy with that one? You'd get there? Okay. Okay, so next one, and you can see it's happening in reality. The regulators having to fix all this all the time. People aren't doing the right thing. Okay. So now an entity does not depreciate its own occupied building because it is of the view that its residual value is greater than or equal to its carrying amount. Okay, so it's not depreciating because it's saying residual value is higher than carrying amount. Okay, and it's reaching this view on the basis of trends. So it's seeing residual value as what is that future cash flow when I'm going to sell it, and I'm going to discount it back to today's date. That's how it's thinking about residual value. Okay. So is this right or is this wrong? If you were regulating this company and they said to you, okay, so the reason why we're not depreciating this otherwise depreciable asset is because we think residual value is higher than carrying amount. So therefore, there's nothing to depreciate. Because when we sell it in 10 years' time, the price of this thing is going up. So we think we will get more money in 10 years' time than the carrying amount today. Okay, and we are using a revaluation model. So we're putting it at fair value in our balance sheet. So we're saying the residual value is higher than fair value today. Does that make sense to you using a revaluation model? Okay, is this right or is this wrong? It's wrong. Okay, how do we describe, how do we define residual value in IFRS? We don't, in concept, it's that future cash flow that we're discounting like these people are thinking. These people are thinking about the economics. In accounting, we don't always do the economics. Residual value is how much would you sell it for today if it was already older and in the condition you expect it to be when end of useful life comes. And that is almost by definition lower than what carrying amount is. Okay, so if it was already older and in the condition we expect it to be in today, it would sell for less. Okay, you might be able to find an exception to that. Maybe a vintage car might be different. The older vintage car might in fact be worth more. Okay, so you might be able to find an exception, but generally you won't find an exception. Okay, does that make sense to everybody? Okay, so they weren't doing residual value the way the standard tells you to do residual value. They were doing what they thought the economics was. Okay, if the standard doesn't say do the economics, you have to do what the standard says. You can't do better than the standard. It's not allowed. You have to do the standard. Okay. Okay, so I hope you found that one interesting. Okay, there we go. Okay, so you can see regulators having to regulate this, showing them what the standard says, why the standard says what it says, okay, and actually regulating them. Okay, so this is, we've done this already today. So if you change your depreciation method from one method to another method, because the way you consume, remember we discussed the aeroplane, you went from units, okay, is it a change in policy or a change in estimate? Help the European regulators. Okay, it's a change in estimate. Okay, they couldn't see. They can now, but they couldn't see then. Okay, because they weren't doing bottom up. They were doing top down thinking. Okay. Okay, and for people that come from top down thinking types of economic models, it is quite a change when you do IFRS, because now you have to do bottom up thinking, not top down thinking. Okay, so you know, if you've come from a jurisdiction where you build from the roof down, and you now have to build from your thinking must be foundation up. Okay, that is quite a change. Okay, so I understand why this is a challenge to many people in many parts of the world. I was just a little bit shocked that the whole of the European Union regulators, including the UK, seemed to think this was difficult. Okay, because if you bottom up, it's not difficult. Okay, so now something that is difficult is impairment of assets. Impairment of assets is difficult. Much, much more difficult than just doing fair value accounting. Okay, because you're not going to tell the truth. You're going to tell something other than the truth. Now we have to work out what is it you're going to tell? What are the guardrails around? Okay, so it's getting complicated. Okay, so it doesn't surprise me at all that one of the biggest places regulators find difficulties and problems in accounting is with the impairment of assets. Okay, so you can see regulators here. This is the UK FRC saying, we ask questions when it's unclear how goodwill is allocated to cash generating units. If the methodology seems to have changed from one year to the next, we want to understand why. We think there's probably skullduggery going on, so we're going to ask some questions. Okay, so and then if it's unclear how cash flows relating to e-commerce are being allocated to cash generating units, okay, we're going to ask more questions about that. So you've got your physical stores, your online stores, how, you know, what's your cash generating units and how you're allocating between them. Okay, and if there's inconsistent cash generating units to what you see in your segment information, then that suggests, okay, there's probably something not right here. So that they're telling people, this is what we look for to see if you're doing something wrong. We think if we look here and we find inconsistencies, we think it's probably wrong the way you're doing your impairment test. So the regulator is actually telling you how they look for your errors. Okay, so because they're assuming the world's honest and you want to do better, but you're just not doing better. So if we help you see how we think, then you're going to do better. Okay, so I'm not sure the whole world is like that, but that's the thought process behind this. Okay, so we ask questions of companies. So we don't tell them they're wrong in these jurisdictions. We write to them and say, we don't understand, you know, can you explain better? And often the answer to can you explain better is, sorry, I'm doing it wrong. Okay, so that's the thinking here. But it's also saying, if I'm just looking at financial statements, I can't be sure what you're doing is wrong. I need to understand why you're doing what you're doing. and then we can discuss to see if it's wrong or not. Okay, so where you have inconsistent assumptions, where you have lots of stories about climate change elsewhere, not necessarily in your financial statements, maybe in the front half that doesn't form part of your financial statements, and then it doesn't seem to affect your impairment testing. So it's so important you're telling me tons about it outside the financial statements, then when it comes to impairment, it suddenly doesn't matter anymore. Well, maybe, maybe not, okay, but it makes me ask questions anyway. Okay, and then with value in use, you're supposed to be testing the asset as it is. You're not supposed to be saying, well, I could double the size of the factory, then cash flows would be much bigger, and the cost of doubling would be less than the extra cash flows I'm getting from doubled. Okay, so you can't say it's not impaired because I would do something, I plan to do something different with the asset going forward. You test the asset that you have got, not some different asset. And that's up for discussion right now. Okay, the ISB is thinking of changing that. Okay, and I think regulators are a bit worried about that. Okay, because you can't give management too much imagination. If you think this asset's impaired, well, let's just imagine we knock the factory down, we build a bigger factory, a newer factory, we're more efficient. Okay, why are we going to let management do that? Okay, but that's up for discussion right now. So the standard isn't changed yet, but there are some people saying we should change the standard to let management say, I'll knock the factory down, I'll double the size of the factory, and then I'll get different cash flows. These are the cash flows I think I'll get. Personally, I think that's, you know, stark raving mad that we would let them do that. Okay, but that's where we are. Okay, so that discussion is happening now. It might change in the future. Why, when we do fair value measurement, on the other hand, do we let people say, well, the market participant that would buy this would knock it down and build a bigger. So, you know, if you think of, I don't know, Singapore, which is a city of high-rise buildings, there's still a 3-story bakery that some family has run for generations sitting in the middle of Singapore. Okay, so that bakery might on a cost model be operating profitably. So their financial statements can say we're making a 20% margin on the goods we're selling. Look how nicely we're doing. Okay, but it's flat crazy that a bakery is being run in a 3-story building in Singapore. So if that building was sold, who would buy the land and the building on which it is built? Who would the market participants be? High-rise building people. Okay, so if you're measuring fair value, it's got nothing to do with bakery. It's got nothing to do with 3-story building. The building's nil. It's just the land. That's all it is. Okay, but if you're the bakery, you've got building that you're depreciating. You've got land. Okay, you might be using the cost model for everything. Because if you use revaluation model, it would tell you you're making a huge loss. So why would you use revaluation model? The truth is a horrible thing. Okay, so just use cost model and pretend you're making a profit. Yeah. Okay, so you can see why when you're doing fair value, the fair value of the building is nil and all the value is the land. But if you're doing value in use, then you're discounting cash flows from a bakery. That bakery's cash flows. And yes, the building's great and the land is great. No, it's just opportunity cost forgone. That's all it is. Okay. So the cost model is absolute rubbish accounting is the way I would describe it. Because it's not telling you that it's crazy to have a 3-story factory in the middle of Singapore when you could have a high-rise building with much higher cash flows, which is what fair value measurement would do. So the revaluation model is great. It's the best model we've got. Okay, the cost model is just rubbish. It's just telling you a little bit of the economics when there's a lot of economics you're not being told about. Okay, so if you're using financial statements to try and forecast future cash flows, and the cost model bakery sends you those numbers, what you have to do is rub everything out and say, okay, so if I'm buying shares in this thing, I want it sold. So I want the fair value of the land. I don't want a building. I don't want a bakery. Okay, do you see the difference? So when we come to do this impairment test, the impairment test is to the higher of fair value less cost to sell, what market participants would get, and value in use, what the bakery is going to get. Okay, so the bakery's cash flows are management perspective cash flows, and the fair value is market participant, high-rise building cash flows. Knock down the bakery, build the high-rise building, and what cash flows are you going to get? The net of all those cash flows is market. Okay, does that make sense? Okay, so it's very different things, isn't it? Okay. Okay, so if they see inconsistencies, so you're saying one thing here in your impairment testing, and you're saying another thing in your, I don't know, whatever disclosures you make outside of your financial statements, that's going to raise questions. Okay, so if you do a director's report, or you do a sustainability report, or you do any kind of report outside of your financial statements, the regulator is going to look at the two and say, are there inconsistencies? Okay, like climate change is a classic example of that. Okay, and this enhancement to asset, if it's fair value, yes. If the market participant would knock down your building and build a new building, then it's the knockdown, rebuild, and cash flows from operating. But if it's value in use, currently, it's not. It's the building you've got. Okay, does that make sense? It's the difference between entity-specific and market perspective. Okay, so they're questioning companies when the value in use appeared to go beyond 5 years without explanation. So typically, companies will forecast cash flows 5 years ahead. And then when you're doing value in use, you just project from that 5 years. You don't actually do the cash flow 6, 7, 8, 9, 10. So when companies appear to be doing that and not explaining why, then they ask some questions. And some will include cash flows that have happened before the date of testing. Well, that's weird because it's future cash flows we're looking at. So why are you including past cash flows? And then the sensitivity disclosures. Okay, so if you're not doing good sensitivity disclosures on your impairments, if these are very significant numbers, okay, then the regulator is going to ask questions about your sensitivity analysis or equivalent disclosures. Okay, and then looking at discount rates, okay, whether they're pre or post-tax and how you've arrived at them, and are you getting different discount rates for different cash-generating units? And the risks are different in different cash-generating units, so we would expect different discount rates. So if you're using the same discount rate for all cash-generating units, it looks like it's wrong. Okay, so, you know, those people that think cost model accounting is easy, you are still deluding yourself, okay, because you have to think of all of this in cost model accounting. If we just did fair value accounting, we wouldn't have to think about half of this. We would just do fair value accounting. Okay, but for some reason, the world thinks cost model accounting is easy, but then is totally incapable of doing it. Okay, which is what the regulators find every time they regulate. Okay. Okay, so companies should ensure that they do their key inputs and assumptions. You know, they should be making sure that they are clearly disclosing the inputs like the discount rates. Okay, and then it should be consistent with elsewhere. They should explain sensitivities. They should be using a reasonable possible change in assumptions for each of the sensitivities. Have you ever seen a set of financial statements this is done properly in? Okay, there are very few that I've seen. Okay, so people like the cost model but can't do it. They think it's simple, but it's much more complicated. Okay, and they don't do it properly. I don't know whether they can or can't. Okay, so the UK has done quite a bit of work. Thematic reviews is where they just take one issue, impairment of non-financial assets, and look at many companies and then write a report saying, generally, we're finding this is all done badly. And then, like I showed you a better practice example, that came from this thematic review. So if you're ever wanting to try and think about how something could look better, search for a thematic review. So the Johannesburg Stock Exchange regulator does a few. The UK FRC does a lot of thematic reviews. Okay, so those thematic reviews will show you better practice and things that people are doing wrong. Okay, so it's quite useful. Okay. So must the entity's treatment of inflation in the cash flows and the discount rate be consistent? So if you're discounting cash flows, must you be consistent in cash flows and discount rates with inflation? Yeah, you've got to be consistent, don't you? Okay, because you can't inflate your cash flows. Okay, so if, you know, Obviously, you've got to be consistent. Okay. Okay, so must the cash flows when you're doing value in use reflect current conditions? So are you testing the asset that you have got, not what market participants might do with that asset if they got hold of it? Yes, you're testing the asset that you have got. That's what we discussed just now. Okay, so you know the answer to that one. Okay, now we're doing level 3 fair value measurement. And you might be doing it by discounting cash flows, for example, because that's all you've got. But you would be using market participant cash flows, not the entity's cash flows. So in our example, the cash flows of the property developer, not the cash flows of the bakery. Okay, so must that reflect the current condition of the asset? No. Like the current condition of the asset, 3-story building, market participants are going to knock the building down and build a case. So it's not got nothing to do. It's market participant perspective. Okay. Okay, and if we back to value in use, must the reporting entity use the same discount rate for all its cash generating units? Okay, I told you the answer a minute ago. Okay, do you use the same discount rate for all your cash generating units? No. Risks are different in different cash generating units. You would expect either risk-adjusted cash flows or discount rates being adjusted differently, wouldn't you? Okay, but those risks have to come out somehow that are different between, okay, those different. And here you've got an example. This is in South Africa again, where a company used the same discount rate for all their cash-generating units, didn't explain why. So the regulator asked them questions. Okay, the answer they came back with, the regulator accepted that coincidentally it did work out to have the same discount rate. Okay, but the regulator is saying, I wouldn't have asked the question if you had just told me the information you're supposed to tell me. Okay, which you haven't done. Okay. So must goodwill acquired in a business combination be tested for impairment in the year of acquisition? So there's a business combination. It happens in September. The year end is December. Okay, do I have to test goodwill for impairment this year? Yes or no? Okay, so let's do a quick poll on that. Yes or no? Okay, so we're getting more yeses than nos. Okay, and in the room, yes? No? And the yes is the right answer, isn't it? So you're doing better in the Zoom room than we are here. Why? Okay, because remember, when you do the accounting for a business combination under IFRS 3, you don't isolate overpayment. Okay, and the reason is the ISB thinks you won't knowingly overpay. So at the time you do the business combination, you're not going to be able to isolate overpayment. So we just put it in goodwill asset, even if there's overpayment. Okay, but then the quid pro quo is you have to test for impairment even in the year of acquisition. So there's some assets you have to test for impairment every year. So goodwill is one. Does anybody know any of the others? Okay, so I'm just going to skip over the multiple choice on the others. Okay, so what are the others you have to test for impairment in the year of acquisition? Anybody know? Indefinite life intangible assets must be tested, and ones that aren't indefinite life, but you're not yet amortizing them. So it could be like development costs or something that you're accumulating. Okay, so the reason you're not depreciating them isn't because they're indefinite. It's just because you haven't finished their development. You'll only start depreciating when you finish their development. So if the asset we're talking about is a machine, do we have to test a machine? Maybe I'll just go to that one so we can run the poll. Okay, so this was indefinite life. Okay, this is machine. Okay. So for this one, do we have to test for impairment every year? Yes or no? Okay, let's run the quiz on that one. So you do a business combination. In the business combination, you acquired machines as well as other things. We've said you have to test the goodwill. You have to test the indefinite life intangible asset. Do you have to test the machine for impairment too? You acquired in September, your year end is December. So by December, do you have to have tested the machine for impairment? Okay, so in the room, yes? No? Okay, no. Okay, so you're doing better in the room on this one. Okay, so no is the right answer. You might have to impair, you might have to test, but you would only be testing if the indicators indicated that you needed to do the impairment test. Okay, so you might do an impairment test, but only if the indicators, whereas the goodwill, the indefinite life, you don't even look at the indicators, you do the impairment test. Okay, so doing the impairment test means you calculate recoverable amount. You calculate value in use, you calculate fair value less cost to sell. Okay. Okay, so this is just, must goodwill be tested for impairment every year? Yes or no? We won't run a poll. Yes. Okay, so every year you test it for impairment. Same with indefinite life intangible assets, not necessarily machines. Machines you're only testing if there are indications of impairment. Everybody happy? Okay. Okay, so you get lots of problems with impairment testing the regulators pick up. A big one is insufficient information is disclosed. So just not enough information. That's the biggest problem you see. Okay, so what kind of disclosures are they expecting to see? They want fuller explanations of the circumstances that lead to impairment. Okay, so they want to understand why or why not an impairment is happening. Okay, so it applies to reversals of impairments and it applies to impairments. Okay, so you can see they're seeing emissions of disclosures. Okay, they're not seeing enough disclosures about significant changes in assumptions in your impairment testing from one period to the next. You should be showing that. Okay, and then they're not seeing some particular disclosures which relate to changes in assumptions, okay, and a reasonable possible change in the key inputs that have gone into the most sensitive inputs into your measurement. So those are the big ones that they're finding most of the problems with. So some people are just not disclosing anything, okay, but many people are making disclosures, but they're not making full enough disclosures. The not full enough disclosures relate mainly to these 2 points here. Okay, so you expected to make that disclosure. Okay. Okay, so if they, if you're writing stories that make it sound as if, there's no impairment, okay, but you're close to impairment, so we call that headroom. Okay, if there's, how much headroom is there from, if you changed your assumptions a little bit, would you have an impairment? Okay, so headroom is speaking about the gap between carrying amount and recoverable amount. When that gap is small, you have a little headroom. When that gap is big, you've got a lot of headroom. So the risk of getting to impairment because you change an assumption is high when there's very sensitive assumptions and headroom is low. Okay, so if you've got low headroom, there are additional disclosures that you have to make. So if when you do your impairment test, you conclude it's not impaired, but you're close to impairment, you've got little headroom, then there's additional disclosures you have to make. How much would these assumptions need to change by to actually end up with impairment? Is there lots of those disclosures made? Not the financial statements I read. Okay, so regulators are beginning to say, you're not making these disclosures. You need to quantify the headroom effectively. Okay, so you see that as being raised. So the JSC raised on 14 issues in this period. Okay, so you can see how that's coming up. Okay, so you can see the regulators are picking up on this. Okay, this is the headroom disclosure that we've discussed already. Okay, and they're not seeing enough information disclosed about that. So they're expecting to see, what's a reasonable possible change in a key assumption that would lead me from not having an impairment to having an impairment. So explaining the sensitivities in the depletion of the headroom by changing the assumptions that you've got. Okay, and I seldom see these disclosures. Okay, so this is really not being done well almost anywhere in the world. Okay, so here we have a state-owned enterprise which has a component of the impairment loss. It is attributing to being an exceptional item. And the piece that it's saying is an exceptional item is because it's calculated the effect of COVID-19. Okay, so it said, I'm going to show that as an exceptional item. So here's my total impairment of 100. Okay, 90 of the 100 is due to COVID. So I'm showing 90 as an exceptional item. Do you think we should accept that or not? Do you think somebody can really isolate the portion that relates to COVID? No. Okay, so we're not going to accept this nonsense. Okay, so this isn't going to happen. Okay, so you can see the regulator doing exactly that, saying, well, I appreciate your fantasy, but I'm not interested in it. Okay, so don't do that. Okay. And then another one is also using exceptional item, and it's just saying everything is COVID. All my problems are COVID. Okay, no, that's also not acceptable. Okay, so we're not going to put up with that either. Okay. Okay, so the next one, okay, so we're looking at impairment accounting, and we're looking at impairment for an equity method investment. So you have an investment, you've decided you have you've determined you have significant influence. So you're using the equity method. Okay, so which impairment test do you have to do? Is it the IFRS 9, or in your case, IAS 39 impairment test? Is it the IAS 36, the recoverable amount that we've been discussing so far? Or can you just choose what you want to do? No, can't choose. Okay, so it's not 3. Okay, shall we just run the poll quickly on this one? Just 2 alternatives, actually. It's either 1 or 2. You can't choose. So it's an investment asset. Okay, but how do we do an impairment test on this investment asset? Okay, what does IAS 28 or whatever it is say we have to use as an impairment test for this? Okay, discuss with the person next to you. Okay, so a few more on the second choice. Okay, so in this room, who's saying the financial instrument impairment test, because it's an investment? Okay, and who's saying, no, it's the non-financial asset impairment test, just because standards are crazy? No one? Standards are, thank you, standards are crazy. We do the non-financial asset impairment test. Why? Well, some idiot decided a long time ago, so that's what we have to do. And remember, we were discussing Kraft Heinz earlier. So you look at Berkshire Hathaway, Warren Buffett's company's financial statements, and I don't know if it's still the case, but a year or two back. So because Kraft Heinz trades in a market, they do the recoverable amount impairment test under US, which is slightly different from IFRS. They come out to a number, and let's say that number is 10 billion. Okay, so that's what its recoverable amount is. They have to disclose, because it trades in a market, that fair value is 8 billion. So fair value is less than the number they're putting there. So what nonsense is that telling us? That this company is going to do better than what any market participant could do with it. So the market participant that would buy this is what Berkshire Hathaway is saying. That the market participant that would buy this from us if we sold it will not be able to make as much money as we can out of this. Really? Do I believe you? No, I don't believe you. And that's why the disclosure is there. That, in my mind, the disclosure there says, disclose so I can see if you're lying or not. That's basically what it says. And another one is, you disclose if you want to. You don't have to. Encourage disclosure if you have fully depreciated in-use items of property, plant, and equipment. Okay, have you seen that disclosure? You've seen companies do it because they want to say, I'm so good, I'm going to make the voluntary disclosures, even though I don't have to disclose this. And what is that disclosure telling you? You're not doing depreciation properly. Okay, so you think you're being good, but you're actually telling me you don't know what you're doing if you make that disclosure. That's all I see when you make that disclosure. You don't know how to calculate depreciation. You don't know what you're doing. Okay, because if you are making the proper judgments and estimates in depreciation, you would not end up with a fully depreciated in-use item of property, plants, and equipment. Okay, so if you're making the disclosure, you're just warning me that you're not doing it properly. Okay, it's the same with this one. You're just telling me that you live in a fantasy world. Okay, well, that's what I see anyway. Okay. Okay, so quite surprising, isn't it, that that's the impairment test that we're doing? You didn't expect that, did you? Okay, so you see, even when logic tells you you would do something different, you have to do what IFRS says. IFRS says you must do IAS 36 impairment testing. Thank you. Okay, so you do IAS 36 impairment testing, and some poor company goes to do the other impairment testing because they think it's an investment. Of course, I must use the investment asset impairment test. Okay, no, wrong test. Okay, go do the worst thing better. Okay, so that's just how IFRS works, I'm afraid. Okay, okay. So sorry, I should just discuss this with you, even though I've showed you the answer. Okay, so in early January each year, our company tests its investments in associates for impairment. Okay, so we've got a December year end, but we're doing the test in January. So early in January, we do the test, and we're doing the write-off in the year that we do the test. Okay, so the regulator looks at this and says, what do you think they say? Probably not right. Okay, if you're writing it off this year and you're doing the test in the first few days of the year, probably at balance sheet date, there's some damage you should be reporting. Okay, so it's just common sense, isn't it? That this is clearly not clever, what this company is doing. Okay, but it could be that there's some random earthquake or flood. I mean, you know, with the more unstable environment, I mean, think if you were in Valencia in Spain and that happened just after your balance sheet date, you wouldn't have been impaired at balance sheet date, you would be impaired after. So it's not to say it definitely would have been impaired at balance sheet date, okay, but it's saying you might want to explain why it's not impaired at balance sheet date, that the impairment relates to the next period. Okay, so was there an event after balance sheet date that caused that impairment? Okay. Okay, so you can see the regulators deal with this all the time. Okay, so now, and perhaps this is the most interesting thing that we'll do today. Okay, we're going to compare recoverable amounts can be calculated two ways because it's the higher of value in use and fair value less cost to sell. So do you understand the difference between calculating value in use and fair value? That's basically what we're doing about. Okay, so what is the value in use measurement objective? What are you trying to measure? If you don't know what you're trying to measure, you're going to make a mess, aren't you? So you have to know what you are trying to measure. So which one of those describes how you are measuring, what you are trying to do when you are measuring value in use? Okay, so is it a present value of future cash flows, okay, that the entity expects to derive from the asset and then disposing of it at the end of its useful life? Or is it undiscounted, same thing? Okay, or is it the price in an orderly transaction to sell the asset? Which one do you think? A, B, or C? Okay, we've discussed this a bit today, so I think everybody knows it's A, isn't it? Okay, so it's a discounted cash flow. It's the entity's expected future cash flows when it's value in use. It's the asset that the entity has. Doesn't matter what market participants think, it's what the entity is doing with the asset. Okay, and if it is fair value, which one is it? C. So completely, we're trying to do a completely different thing, and I think that's what's important. So remember our 3-story building in Singapore? Okay, we're looking at the high-rise cash flows. We're not looking at the bakery cash flows, where with value in use, we were looking at the bakery cash flows. Okay, so you have to understand that. Okay. Okay, so whose eyes must management look through when they're making judgments to measure value in use? So if you're the auditor or the regulator and you're going to a company that's done value in use, they've said recoverable amount is value in use. What eyes do you look through when you're assessing their calculation of value in use? Management's eyes, auditor's eyes, regulator's eyes, general public's eyes, market participant eyes, competitors' eyes, okay, or investors and lenders' eyes. Management's eyes, because it's management's forecasts of future cash flows. Okay, so it's management's eyes. Everybody agree? Value in use, management perspective. And if it's fair value, market participant eyes. Okay, so now it's high-rise building, not three-story bakery. So it's market participant eyes. Okay. Okay, so what is the assumed use when measuring value in use of the asset? Is it bakery or high-rise building? It's bakery. Okay, so it's the use to which it's being put. And if it's fair value, high-rise building in our example, isn't it? Okay, so it's what the market participant would do with it. Okay, and it can even be more nuanced than that. You can have farmer next to other farmer. When you're doing value in use, it's that farmer's cash flows. If highest and best use for that land is farming, and you're measuring fair value, it's market participant farmer cash flows. The farmer that would buy the farm, not the farmer that's operating the farm. Because you get some really bad farmers. So it's not the bad farm. The bad farmer's cash flow, if it is bad farmer, is value in use. The much better farmer's cash flows is for fair value. Because who is the market participant that would buy? The farmer that's going to farm better, isn't it? Does that make sense? Okay, if highest and best use is farming. Okay, very good. And you all knew this before you came today, didn't you? You understood all this clearly. That's why you're getting this all right. Okay. Okay, so which valuation technique is used when measuring value in use? It has to be discounted cash flows. There's nothing else for value in use. Okay, it's the business's discounted cash flows. That's what it is. But you must reflect not just most likely cash flows. You have to have multiple scenarios with timing and amount different. So it's not a back of the envelope calculation. It's a spreadsheet calculation with multiple scenarios. And I think that's important to understand. Okay, so which valuation technique when you are measuring fair value? Discounted cash flow, is it whatever market participants would use? Okay, C, whatever market participants would be using, because it's market participant view. Okay, so who are the relevant market participants? The ones who would be the buyers. So if this asset was auctioned, who would buy it? Not James or Peter or June. Okay, but who's the market? Is it property developer? Is it farmer? What is it that would buy this? Okay, so, okay, now because that's too easy, okay, we have to have a look at something more complicated now. So you all know what an executory contract is. It's a contract to buy or sell a non-financial item. And we generally don't account for executory contracts. If you've entered into a contract, if you're an airline, you've entered into a contract to buy jet fuel for next year and the year after, you haven't paid, the fuel hasn't been delivered to you, the contract is just specifying the price and quantity and timing of delivery. So we generally don't account for that. Even though the price of jet fuel might have changed significantly, we just ignore that economics if we're doing cost model accounting, which is a little bit weird. Okay, but that's just how weird accounting is. Okay, so what this diagram is going to do, it's just going to take you through the steps that you need to go through in thinking about this. So if that contract must be settled net in cash, you're never receiving jet fuel, you're never paying the gross price, it's just a bet on what the future jet fuel price will be. If that's how it is working, It is a derivative, and it's accounted for as a derivative financial instrument at fair value through profit or loss. So some of these contracts, that's not an executory contract, it's a derivative. Okay, so you account for it as a derivative. Okay, but if the contract is in the second box down there, if the contract doesn't satisfy the definition, or sorry, does satisfy the definition of can be settled net in cash. So can be settled net in cash sounds like you have an option. You can choose to pay cash, or you can choose to take the jet fuel and pay for the jet fuel. That's one meaning, not all the meanings. Okay, so if you go to paragraph 2.9 of IFRS 9, or there's an equivalent paragraph in IAS 39, it is cut and paste from IAS 39. Okay, it could just mean that the underlying is readily convertible into cash. So if the underlying is easily converted and readily convertible into cash, okay, then you treat it like a derivative. Okay, so if the underlying is readily convertible into cash, okay, then it can be treated as a derivative. Okay, if it can't, it's an executory contract. So you get kicked out into the executory contract. But if the underlying is readily convertible into cash, like jet fuel arguably is readily convertible into cash. Okay, gold certainly is, crude oil certainly is. Okay, then you ask yourself, does the own use exception apply? So am I going to get this jet fuel and use it to fly my aeroplane? Yes, the own use exception applies. Now I don't have to account for it as a derivative. If the answer is no, I'm just speculating. Yes, I do have to account for it as a derivative. Okay, but one more step, if you've said the own use exception applies, okay, you then have to convince yourself that you are reducing, okay, a accounting mismatch by accounting for it at fair value. And only if you're reducing an accounting mismatch can you account for the piece of paper at fair value. Otherwise, it's an executory contract. So I come from a farm, so I always like to explain things in terms of a farm. So if you're a farmer and you've entered into contract to sell a cow next year, and you fixed the price at which you're going to sell the cow. Okay, so you've now fixed the price, but I fixed the price 3 months before balance sheet date. I get to balance sheet date, and I'm either happy or sad that I've fixed the price, because the price of cow has changed, hasn't it? Okay, so if the price of cow has gone up, I must still be accounting for my cow because I still control the cow. So the cow is going to go up, and you account for cows at fair value. So the cow is going up in my books. Okay, I'd avoid an accounting mismatch by accounting for the paper at fair value. So the paper would be a liability and I'd have an expense, and the gain would offset the loss. So I'd be neutral in profit. Does that make sense? I'm avoiding an accounting mismatch by accounting for the piece of paper at fair value. I have to account for the cow at fair value. Okay, so I have to show the increase in the cow. I can avoid the mismatch by also accounting for the piece of paper. It will have an equal and opposite change, so my effect on profit will be nil. Because if I don't do that, I'm going to show a gain on the cow now and a loss on when I sell the cow next period, aren't I? Okay, so you're avoiding that, basically. Okay, but you have to be doing that in order to account for the piece of paper at fair value. Okay, otherwise you mustn't account for the piece of paper at fair value. Okay, so all that's really important to understand is some of those pieces of paper are accounted for at fair value and some of them aren't. Okay, so I'm going to go over time just slightly, just because this is so interesting and exciting. I can't help myself. Okay, so this is really quite, I think, difficult to understand, but once you understand it, it makes perfect sense. Okay, so sometimes those pieces of paper are in our balance sheet, sometimes those pieces of paper aren't. And this diagram tells you whether it's in or out. So if the piece of paper is in your balance sheet, is it relevant to measuring fair value? So the piece of paper is an asset in your balance sheet. Okay, is it so now you're measuring the fair value of something. I mean, this could be, you know, jet fuel that you're buying to fly your airplane, and the piece of paper is in your balance sheet. Then can you, when you're measuring out your airplane's cash generating unit, whether it's impaired or not, Okay, can you count the fact that you've got this piece of paper in measuring the fair value of your aeroplane? Or do you think it's irrelevant to measuring the fair value of your aeroplane? What do you think? Would you think about the price in that contract when you're measuring the fair value of the aeroplane? Or is the fair value of the aeroplane separate from the fair value of the piece of paper? Okay, it's separate from the fair value of the piece of paper. So whether or not you have entered into a contract to sell your cow, that does not affect the fair value of your cow. You've got two things. You've got a piece of paper to sell cow, and you've got cow. So if you've entered into contract to sell your cow, you've got two things. You've got cow and piece of paper. Fair value is of the thing that you are measuring. Okay, so it's irrelevant to measuring the fair value of your cow. Okay. There's one exception in IFRS when it comes to fair value measurement. For some reason, unlike the Americans who could see the right thing to do here, if you're measuring fair value of investment property and you have an active rental agreement, you use the cash flows in the rental agreement if you are discounting cash flows. Why on earth are we doing that? That's like the contract to sell the cow, isn't it? So contract to sell cow you ignore when you're measuring fair value of cow. Contract to rent out building is relevant to measuring the fair value of the building. So we're using the actual cash flows from the rental. Why are we doing that? It's an exception. It's stupid. We shouldn't be doing that, but we are required to do that under IFRS. So the way you measure fair value under IAS 40 is different from what fair value is because you use that contract. Instead of saying I've got two things, I've got contract and I've got building, you put the two together and measure the net of the two. When it's cow, you don't put the piece of paper together with the cow, you keep the two separate. Obviously, they should be kept separate. Okay, if you're doing value in use calculation, if we were accounting for cows at value in use, then the price in the contract to sell the cow is the cash flow you expect from the cow, isn't it? Okay, so if you were doing that, you would use the price in the contract to work out value in use, wouldn't you? Okay, now it gets a little bit more complicated where you've got a process to get to something. And say you've got your oil and gas company or something, okay, and you're trying to work out whether you should impair your oil rig or not. And you've got inventory oil you've extracted that is sitting in tanks here, and you're doing value in use, and you've got contracts to sell oil, then you have to say, okay, so it's entity specific, so these contracts matter. But if I've got oil in the tank I'm going to deliver under the contract, then those contracts for those that are in the tank are relevant to inventory, not to the oil rig. Okay, because the oil rig's different from the inventory, isn't it? So the ones that aren't for the oil in the tank now, you use the price in those ones for the oil rig, don't you? Okay, so we did so many exciting things. I couldn't not discuss that with you before we stopped. Okay, so yeah, I think my time is up for today. So sadly, we have a 1 hour break, and then Daryl and I will do Q&A with you after the break. So thanks for your attention. Okay, welcome back, everybody. Okay, so it's Q&A time. So if you have any questions on what we did yesterday or what we have done so far today, we're happy to answer any questions that you might have. Any questions anybody has? Don't feel you have to. We can get Daryl up to start the next session if you don't. So don't feel you have to have questions. And feel free, of course, to write any questions down that you might have. Please, in the English language, if you can do that, or we'll have somebody translate it if you can't. And then we can answer those in tomorrow's session. But if anybody has questions, we're happy to answer any question that you might have. Well, good. Okay. Good luck, Daryl.
All right, so Mike obviously explained everything very well this morning. Well, thanks everybody for coming back this afternoon. Hope you all had a good lunch again. This afternoon we'll run pretty much then to the plan that we had for yesterday. So we'll run for about an hour and a half, then we'll take a coffee break, and then we'll finish off with perhaps another 45 minutes to an hour at the end before we call it. Subject matter today is revenue. So I think what we've been talking about up until now, and I said to you this is going to happen a little bit. Yesterday was an overall, how does the IFRS foundation work? And then talking about some of the specific issues raised by the foundation. Then we talked about the brand new standard IFRS 18. Today is now changing the topic a little bit. We're starting to move into real life. And what Mike was talking to you this morning is what are the real life mistakes that people make? Where are the really important judgments you need to think about? How do you go about making those judgments? This afternoon, I'm going to start talking about one of the really important areas of the financial statements that you produce. And this ties back to some extent to the conversation we had yesterday afternoon. Yesterday afternoon, we were talking about performance and how you present performance and how you make it easy for people to understand your performance. That is the overall thing about the presentation. What we're now going to be getting into is a little bit of detail about how you measure the things that you present. And then specifically going to be talking about financial performance and drilling down into financial performance about the revenue aspect. But I thought I'd start by taking a step back and just talking to you about this concept of financial performance. What is financial performance? I imagine if Mike was talking this morning, I can't imagine Mike not talking about the conceptual framework. So what is the conceptual framework? It is the basis or the foundation on which standards are built. Okay. So the conceptual framework goes out there and it says, this is what we're trying to achieve. And then each of the individual standards start saying, okay, this is how we achieve it, how we achieve that thing in the concepts when we are thinking about one particular topic. And the conceptual framework defines financial performance. It says financial performance is really, really important because it tells me about how the company is progressing over time. And so financial performance is simply the change in the entity's resources and claims. So when I think about what did I have last year? My assets. What did I have last year? My liabilities. How have those changed from last year to this year? That is my financial performance, minus any equity transactions that have occurred, minus anything that happens in the equity space. Why do we want to know about financial performance? We want to know because it helps us understand what the nature is of the returns the company has produced. So whether this is my personal company, Darrell Scott Incorporated, or whether this is HSBC or a really big company operating in the world, we need to understand what is happening to that company from one year to the next. Is it growing? Is it shrinking? Is it making profits? Is it making losses? Is it making a net return? Financial performance helps me understand what has happened in the past. But it also helps me understand how well that company is being managed. So if I want to make a decision about whether we have the right CEO, whether we have the right CFO, if I want to make a decision about whether this company is paying the right salaries and the right performance, I need to understand how well those people managing the company have managed the assets and liabilities they started with. Have they made them better? Has it got worse? And I need to know that because I need to know whether those are the right managers for the business. So it helps me understand what has happened in the last 12 months. It also helps me understand how it has been managed, how well it has been done in the last 12 months, and whether I have the right people in place to manage it. And then the last bit, which is just as important, is it helps me think about the future. How well will this company do in the future? So if I tie this conversation back, and let me see if it's, let me first go through a couple of others, and I'll come back to yesterday's slides for a sec. So when I think about the elements, it's about the change of resources, the changes in claims from year to year. And then the conceptual framework says the way I think about that is I think about it in two parts. The income that comes in and the expenses that go out. Okay. How much income has come into my company during this year? How much expenses have gone out? Again, this is bread and butter. This is basic stuff. There should be nothing here that would surprise anybody, but you can see how it's expressed in the conceptual framework and how the conceptual framework uses it as a basic element or basic talking point. So we would say, when we are looking at the financial statements, in the bigger picture, we have 5 core elements. Again, you'll all know these elements: income, expense, asset, liability, and equity. Those are the 5 key things. The statement of financial performance is about 2 of those, the assets and the liabilities. The income and the expenses. And the way we define income and expenses is by the way our assets have changed, by the way our liabilities have changed over time. So this is how the whole income statement, balance sheet gels together when we think about it in these terms. This was the slide we talked about yesterday. And you remember what I said yesterday, what we were talking about yesterday, and what we've talked about today. What is the purpose of financial performance? It is to help people understand how well the business has operated. Has the business operated the way it's meant to? How well has it been managed? What has it achieved? And when we talked about this yesterday, we split it up and we said operating. Operating is essentially the conversation that management has about how well they are running the core thing. So if you are manufacturing, the example we used yesterday, if your job is to manufacture Teslas, how well have you manufactured Teslas? We ignore everything else. We take everything else out of the equation and we just look at that operating process for the management, for the manufacture and sale of Teslas. That's all we worried about. And then we talked about how we have the other areas. We have the investing area, we have the financing area. What are those areas about? Those areas are about how have you managed the resources you were given to do the operation. So did you have too much money and you made investments? That's how you've dealt with the too much money. Or did you not have enough money and you had to do borrowings, you had to make borrowings? This is the ancillary stuff around the outside. If I start the question that you are going to be asking the management of a company if you're a shareholder, I want to know how well the core business is working. Okay. And then I want to know how well the other things around the outside of the business are working. And I want to be able to have that conversation individually so that when I'm looking at the operating as a shareholder, I can say, you manage Teslas. How well was the Chrysler and the Volkswagen and the other companies who do the same thing? How well was their core business? And there's how is each of these elements managed? So financial performance, this is really what we talked about yesterday. Those are the changes that came through from yesterday. We're now focusing in. So we're drilling in our focus, narrowing in what we're looking at. Same picture as yesterday, but IFRS 15 is only about those top 2 lines. It's not telling us how we do anything else on this income statement. It's simply telling us how we think about those top 2 lines right at the top. Okay. This already tells us where we disclose it. Already tells us where we present it. We present it right at the top. Now we talk about how we measure it, how we recognize it, how we decide when and where it is important to have the information placed and how it's done over time. And so that's how yesterday ties into today. I mentioned that this, when we talked about it yesterday, is brand new, only coming in 2027. But the idea that the top 2 lines are revenue has come from the previous standard. Okay. And maybe I'm just going to ask a question in the room. I'm not going to ask it online this time, but just to ask a question in room. Who here is already applying IFRS 15? As opposed to in what you're doing, applying, are you still using, well, let me ask the question the other way. Are you still applying the old standard, which is the IAS 18 in North Macedonia? Okay. So we're still working on the old standard, which is IAS 18. What I will say when I talk about the new one, and it's going to be then implemented, I'm guessing, from next year in North Macedonia, for many, many companies that apply this, the outcome is very similar to what it used to be. But when it is different, it can be very significantly different. And what I'll do as we talk through it this afternoon, I'll give you some specific examples of where differences come in and how those differences work. All right, again, just to say, principals, we will be asking you questions as we go through, but if you've got any questions anywhere, you're welcome to put your hands up and ask, and I'll stop and answer the question at that point. And the same goes for everybody online. If you are online, if you do have any questions, you're welcome to ask the questions, and we'll deal with them as they come up. Okay, so what does IFRS 15 say? It starts by saying it is the standard for contracts with customers. So it applies when you have a contract with a customer. Okay, I'll come back to this one because this is not about revenue, but thank you very much for the question, and we'll come back to that a little bit later, perhaps just before, just after coffee. It's about contracts with customers. So a contract with a customer, this is something I am entering into with somebody on the outside, but not somebody who's just anybody. This somebody on the outside has to be a customer before IFRS 15 applies. Oh, this is now... Thank you. So let's just go back on this one. There you go. And you can roll this one out until the bottom. There you go. All right. What are you looking for? What is a customer? A customer is somebody who is buying the thing that you produce as the ordinary activities that you as a company do. So remember, we talked about this yesterday too. We had the example yesterday where we said, well, if Tesla goes out and starts financing purchases of cars, is that financing activity part of its ordinary business? Or is that simply to supplement the sale of cars? Okay, same concept here. What I've got to think about, is this something that I've done that is unusual? Or is this something that I do that is part of my ordinary activities? If it is part of my ordinary activities, then the person I am selling to is my customer, and I will think about this from a revenue perspective. And of course, a contract is always an agreement between two parties. Two different people have to agree in order for there to be a contract. So I think the first thing, and the standard says this very clearly, a contract, you have to have a contract when you are entering into a sales transaction. That has to be the core of it. But a contract does not need to be written down. A contract can be a verbal agreement. I agree with you that I'm going to sell you a car. You agree you're going to buy the car. That's good enough for us to consider that in that case there is a verbal contract. But even more than that, a contract can be implied. So when I go to the lint shop and I buy myself a chocolate, I go in there, I say I want this chocolate, I give them the chocolate, they take my credit card. There is an implied contract between the two of us. That is not written down anywhere. There's nothing to see, but it's implied, so the contract exists. So it doesn't mean that you have to have something that's written and put in a safe somewhere. Anything that is an agreement between two parties is considered a contract for the purposes of this. And obviously, the contract has to be with another person. So you can't have a contract with yourself. The company can't have an internal contract. You can agree to do things in your company. So the Tesla sales division might enter an agreement with the Tesla financing division, but that is not a contract for the purposes of this because it was with the same person. Tesla is in both sides of that equation. So there must be another person. The other person must receive or get goods or services from you. It must be the output of your ordinary activities, something you do as part of your conventional ongoing activities, and you must be paid for it. You must receive consideration. Now, consideration does not need to be in cash. So I can agree that I will sell you a motor car in return for you giving me a truck. We swap. Or perhaps we've agreed that I will sell my second-hand car to you and you will sell your second-hand SUV to me, and we decide they're both worth the same, so there's no exchange of money. So a barter transaction is also, or can also, be a sale in this context. It doesn't apply to certain things. So it doesn't apply to financial instruments. If I, for example, if I give you a loan, that's a financial instrument between us. That loan does not create revenue. It creates interest income and other things, but it doesn't create revenue. It doesn't apply if you're looking at lease contracts, because there's a separate standard for lease contracts. The insurance people in the room will be very happy to know that it typically does not apply to insurance, and I'll talk about some of the exceptions a little bit later. And it doesn't talk or doesn't cover non-monetary exchanges between people in the same business, where the non-monetary exchange is simply for the sake of facilitating businesses going forward. So a motor car dealer that sells, let's say, Toyotas, finds that in the part of the country they sell a lot of red Toyotas, and they end up with white Toyotas left behind on their forecourt. In another part of the country, the car dealer there is selling a lot of white Toyotas, and he's left with unused red Toyotas. So the two dealers agree that I will give you my red and you give me your white. It's exactly the same motor vehicle, exactly the same good. The only difference is the color. That is not the ordinary course of business. It is not a sales transaction, and we would not treat that as revenue for the purposes of IFRS 15. It's not in the scope of IFRS 15. So we talk a lot about this example. So a coffee company, just because every time I come here, I drink a lot of coffee, so I assume that there's activities going on in the coffee space in the whole area. So you got a coffee company. The coffee company sells coffee beans as a normal course of business to one of its counterparts. So if it's selling coffee beans as a normal part of business, that's what it normally does. You would expect that to be considered revenue. In this particular case, though, it has made a decision that it is understocked of coffee in one particular region. And it speaks to one of its competitors. Its competitor is overstocked with coffee in that region. So they agree to do a swap. They swap in the other region. Let's say, what did I say this was going to be? They swap in Skopje and they swap in Podgorica. They just switch between the two warehouses so that they can give effect to the delivery. Okay. This is a transaction that can very easily happen, and that often happens. Neither company, so there you go, neither company has a sale. They've both, in two different offices, they have moved coffee between them. Within those two offices, if they are preparing their own financial statements, they may have to record their financial statements in the office in Skopje. They might have to show that they've got a sale and a purchase. But when they do their consolidated accounts, neither of these companies can record a sale. Neither of these companies can record revenue, because all they've done is a swap. All right, so I think that's... Okay, so just when we talk about this company, what I'm going to do is I'm going to spend a bit of time coming back to this company every now and again. So as a coffee company, I've picked one type of company, so the whole way through what we're doing is just the same sort of example over and over again. So what does this coffee company do? It buys and sells coffee under normal conditions. So it has to source its beans somewhere in the world. It sources those beans in the world, it brings them in, it does some of the own production in country, and then it sells those coffee beans either within local markets for cash, for credit. It sells it in local currency or in US dollars. So it's a normal company. It's doing a bunch of normal stuff. Coffee beans are a commodity that trades on international markets. And so you see coffee bean prices going up and down all the time. I think everybody knows that about coffee beans. And so there's actually an active traded market for coffee beans. You can buy coffee beans for delivery in 1 year's time. You can sell coffee beans for delivery in 1 year's time. You can buy coffee bean futures. So this company, in order to make sure that it is comfortable from that perspective, it also buys and sells coffees in the futures market, coffee beans in the future market. Some of the coffee it sources comes from emerging countries in the world. Ethiopia is one where I've been and I've drunk their coffee. So what it does is from time to time, it lends support to the farmers in those countries, either through loans or through equipment or other things. And that's really to help it secure its supplies. It's not into the business of a bank, but it wants to help secure its supplies and make sure that it can continue to look after its supplies over time. And it holds US dollars to protect itself against currency fluctuations. So sometimes it sells in US dollars, keeps those US dollars. When it needs to buy in US dollars, it hangs on to the US dollars. And any excess cash it has, it doesn't want to take any risk, so it invests whatever excess cash it's got just in government bonds. Okay. And then finally, it holds a small stock of gold coins. Mike and I come from South Africa, and so we love gold. So whenever you talk to us, we'll always be talking about the way to protect yourself is gold. So it's got a small stock of gold coins that it keeps just to help it when it needs to protect it from fluctuations in currencies that it's dealing with. Okay, so this is the company. We're going to talk about this company a lot this afternoon. We're also going to talk about this company a lot on Friday afternoon. It's nice and simple and easy to understand. It's got an easy business model, and hopefully just about everybody in the room drinks coffee, so we can kind of understand what its business is and what it does. Yes, sir.
Example, however, in the title of the company,
Yes.
Kafana, when we mention Kafana, we think of rakia, not coffee.
Okay. Well, that's always good to know. I thought everybody was enjoying the example a bit too much. So this is part of the learning process. Okay, so I'm going to, from now on, I'm referring to it as KCC. We'll keep it that way. Okay. All right. So KCC, explicitly, as I said earlier, it wants to help secure its supply of coffee beans. So what is it doing? It buys coffee beans from Ethiopia in this case. It wants to support those suppliers in Ethiopia. Ethiopia has got big problems sourcing stuff from outside the country. So what it does to help Ethiopia is it says, we will supply you with the farm equipment, and we'll figure out a way that we can do this payment because we know we want your product. So they're trying to help the people who produce their product. So it sells equipment to farmers in Ethiopia. It sells them at a market-related price. So it's not trying to give a special on the pricing or anything like that. It is a business that is profitable in its own right. So it makes a profit on this business. It's got a net positive turn. It has its own team that's out there sourcing the equipment and selling the equipment, and it reports it in its financial statements as a separate segment. So it actually says this is a separate part of our business. But the business focuses only on the suppliers to KCC. So the only one it focuses on is those companies that are supplying goods to KCC. It's not worried about the other farmers in Ethiopia or other farmers in the world. Again, we'll ask this one as a question. Goran, if we can do an A-B question online. So this is a very simple one. Are the contracts with the suppliers for the sale here? Are these contracts where we sell the factory equipment? Do we think this is revenue? Do we think this is in IFRS 15? Or do we think this is not revenue, it's outside of IFRS 15? What do we think? In? So raise your hands if you think in. It is revenue. Okay, so everybody else thinks it's not revenue. Okay, so we got a difficult one. This is like the one we spoke about yesterday, isn't it? And I'm looking now at the numbers coming up here, and it's about 50-50. So round about the same in the room, also what we saw over there. We've got a problem because this is a difficult example, because the thing that we have to think about with an example like this is what is the real intent of the business? Okay, what are we intending the business? Now, I'll give these guys a minute more before I give away too much. But I think that looks like we might be the end. Okay, so about 50-50 online, more people saying no than saying yes. All right, let's go back to the slides, I think. So we have an example here. The first thing that I think is important is it requires judgment. And the judgment comes in, if I looked at the first 3 bullet points there, it sells equipment at market-related price. That sounds like a normal business. It is profitable in its own right. So it makes a profit in its own right. That sounds like a business. It has its own dedicated resources. Sounds like it's a little business in the company. It's reported as a separate segment. I'm thinking of it as a separate business. All of those tell me this is probably a separate business. And then I've got this last one. The only people I sell to are my own suppliers. So now that's the one that gives me a twist the other way. So 4 have been this way, 1 has been the other way. My answer on this one, my judgment, assuming this is a material part of the business, is that, okay, hang on. My answer to this one is that this is probably a business. And if it is a business, this is part of my ordinary activities, I would therefore treat it as sales. The reason why I would make that answer is because I should. In fact, most of the time I do as a company choose my customers. Sometimes the characteristics are I only want customers in a particular area. Sometimes the characteristics are I only want a customer in a particular credit level. I usually choose my customers. This is just a different way of choosing my customers. And so in my mind, I'm looking at this one and saying, I think this probably is a sales. I would probably treat this as part of my normal activities. But you will look at other things. You'll look at how often you do it. Is this happening all the time? Lots of the stuff there, like dedicated resources, profitable in its own right, tell me that the answer to those questions is probably yes as well. So I look at some of the other things this company does. And again, Goran, if we can do a question on this one. I'm going to just, in fact, I'm going to tell you the answer to the first one, and then we'll go on to the second one. So the first one hopefully is easy. Income from the sale of coffee beans must be sales. We're all happy. That must be part of my sales. It's part of my ordinary business activity. Income from forward sale derivatives. So I've bought a derivative with an intention to sell it in the future. Now I sell the derivative. Is the income from that? Do you think that's part of my normal business activities, my relationship with customers? Okay, let's ask the question. So A is yes, B is no. Other income, other income. The room feels pretty strongly other income. Online, I don't know if we gave that away, but it looks like the online also feels quite strongly. It's other income. This is normally going to be trading income, isn't it? I mean, if I'm thinking about forward sales of derivatives, I'm probably thinking about other income, something in the future. So that's the way I would think about this one. Okay. Other income in this case is probably trading income. The only exception might be if I genuinely plan to deliver the coffee beans. So think about this. What I've done is I've said, I am selling, we think about it as a derivative, but if I say to you, I will sell you coffee beans for delivery in 1 year's time, that is still selling you coffee beans. The fact that delivery is in the future doesn't change the fact that I'm selling. So that one is, I'll ask the question, we won't put it online for this one. Income from loans to suppliers. Okay, am I a bank? Well, so this is probably not. This is probably not a revenue. Income from treasury bills. Am I an investment company? No, I'm not. So this is probably not revenue. And in any case, both loans and treasury bills are financial instruments, so I wouldn't include them. I think something interesting is going to happen with this slide. I apologize for the fact that this slide's in English, and I think when I press the button again, it's going to suddenly turn into Macedonia. That's the way I set up the slide, so apologies for that. And there's the answers. So the packs that we distribute to you will have this type of answer in it for you. Okay, so you've actually got the questions and the answers in the final distributions. Company purchases farmland from one of its suppliers, those same suppliers that it typically lends money, that it sells farm equipment to. It purchased property from the owner of the farmland for $80 million in this case. It then, 6 months later, resells the property. So it's selling the property back into the market, and now it's sold it for $100 million. At the end of the year, the contracts had all been signed. So everything had been signed, everything was happening, no problem at all there. However, registration had not yet gone through. So the property had not yet been registered in the buyer's name. So I've sold something, okay? I've agreed the price with everybody, but nothing's happened yet because we haven't actually seen registration happen. So the question here, which of these is this? There you go. Sorry, can you go, Goran, can you go forward one on the, this side. So we're on slide 23 for both. There you go. Okay, so the question here is simply, how do I treat this? And if you can ask the question online, we can do this one. So we've got A, B, and C. Okay, there's 3 options here. A is that I'm going to record a sale, an IFRS sale of 100 million. So a revenue under IFRS 15 of 100 million. And I'm going to record cost of sales of 80 million. Okay, is A. B is, I am going to, now is where I get confused with the languages. So B, thank you. Thanks very much. Cost of sales. So the first one is revenue, cost of sales. The second one is I record a liability. I've received the money, but the property is still registered in my name, so I can't do anything under B. And C is I just recognize 20 million of net income in my income statement. So I recognize revenue and cost of sales, or I recognize a liability because nothing has happened yet because the sale has not yet been registered, or I only recognize the net of 20 million. Okay. Getting a bit more difficult. Any thoughts? Who thinks this is A? So it's interesting. So the room is saying predominantly no sale has happened. Okay. What do you think? Sorry, the online is thinking predominantly no sale. What do you think in the room? Who votes for A? Nobody. Who votes for B? Okay. Who votes for C? Okay. So you've got roughly the same mix. What's actually quite cool is that the room is very similar. You might be cheating, but the room is very similar to what's coming in online. So again, I think, thank you, that's perfect. And thanks everybody online. Again, I think it's interesting here because this is not a simple example, is it? The first thing I think we can probably say is that A is wrong. It is not A. It's not A because this is not your normal course of business. You bought this property because somebody died. You got the opportunity to hold it and then sell it on to somebody else. It's not part of what you normally do. Okay. So that leaves me with B or C as the two answers I need to think about. B comes down to how the law works in North Macedonia, in the other countries. So let me ask you a question back. Can the property, for any reason whatsoever, once you have got a valid agreement of sale, can registration be declined? Okay, I'm seeing, I take in South Africa. South Africa registration takes 3 months, but it is an administrative process. Okay, same in North Macedonia. So what you would say then is the right answer here is C. All you've got to wait is for somebody to tick a box somewhere, but the reality is the property is sold and nothing can unsell the property once you've signed. Okay, so this is what we've got to think about. We've got to think about the substance here. If I say that this is, let's say I'm buying a company and the competition authority has to approve the sale, and it is my competitor that I'm buying and there's some uncertainty, then the sale has not happened until the suspensive condition has been met. But if this is just an administrative thing, I ignore it and I say as soon as I have a binding agreement, I would recognize the transaction. But in this case, the transaction is not a revenue transaction. So all I'm going to recognize is I made 20 million of profit. And profit on the sale of property, plant, and equipment, or other income, or whatever descriptor you use for that. We do have to think about sometimes contracts that are very complicated. Okay, and just because we have some people from the insurance industry in the room, I'm going to use them as an example. For reasons only best known to the UK, when you take insurance in the UK, they give you a free something. So I take insurance and I get a free television set. Or if it's very bad insurance, I take insurance and I get a free pen. But I get something free with it. This is a transaction that's got two things happening in it. On the one side, it's got an insurance. On the other side, it's got a free TV. And I've got to think about how those two things work. So what you start with is you will look at the other standards and say, is this contract? So I'm thinking this is the sale of a TV. But I first have to ask myself, does this contract belong somewhere else? Because it has insurance, it belongs actually in IFRS. I've got IFRS 4. It belongs in IFRS 17 because it is part of the insurance standard. Then I ask the question, does this other standard tell me what to do? And what IFRS 17 says is you must cut the contract into two pieces. You must have insurance and you must have sale of TV. And we'll talk about this a lot later on in the session today. But the principle in IFRS is nothing is free. So when somebody says to you, buy my insurance contract and I'll give you a free TV, what they're saying is pay me insurance premiums and I will sell you a TV and I'll use the insurance premium to pay for it. I have sold you two things because nothing is free. And so what you'd be ending up doing with this is you'd say, well, okay, IFRS 17 says split the contract into two, decide how much of the money is for insurance and how much of the money is for free TV. And then you account for the free TV under IFRS 15 and you account for the insurance under IFRS 19. As soon as you get into these contracts that have more than one thing in place, you have to look really hard at them. A good example that comes up a lot is actually under IFRS 9. When you take a loan, when you go borrow money from the bank for, let's say, to buy your house, okay, the bank will say to you, great, I'll lend you 1 million. I will charge you 5% interest, but I'll also charge you fees to register the house and fees to process the credit check and et cetera, et cetera. There's a clear contract where there's more than one thing happening. I'm borrowing money and I'm paying fees for services. And applying IFRS 9 with IFRS 15, the money that's borrowed would go into IFRS 9, okay? And the fees would go into IFRS 15. Part of the process that you're going to have to think about. This is then the guidance that the standard provides. Okay. So that's the background. This is how you get into the standard. So everything we've gone through up until now is to say, is this a revenue with contracts customer? Am I within the scope of this contract? So some of them we said were just swaps. They're not in the scope. Some of them, like the sale of farmland, is just sale of property, plant, and equipment. That's not in scope. Once you've gone through all of that, now we get to the point where we say, okay, I'm in the standard. What is the standard going to tell me to do? And the standard is based on this principle of satisfying performance obligations. Okay. What is a performance obligation? A performance obligation is the thing that I, the seller, promise you, the buyer. Okay. So in the simplest sense, when I went and I bought the Lindt chocolate from the shop, the chocolatier was promising me a chocolate. That was the performance obligation. And when that chocolate went out of the shop, it was finished. The chocolatier had done everything they needed to do. They'd done the whole service. The performance obligation in the terms was satisfied. Okay. But when I sign a contract with a mobile phone company, it's not finished when I walk out the shop. It keeps going. It keeps going for as long as I am allowed to use the phone that I got from the mobile phone company, as long as I can use their signal, as long as I can use their data. And so this concept of performance obligations is the critical one to this. And what we would say is that the chocolatier recognizes revenue the moment I walk out the store, because their job's finished. Okay. And the mobile phone company only recognizes revenue a little bit every month for the whole of, let's say it's a 2-year contract, for the whole of 2 years. Because they haven't finished the job on day 1 or day 5 or day 10 or day 365. They've only finished the job on day 720. And so the principle here is you've promised to deliver something, and then you recognize the profit when you, or you recognize the revenue when you deliver on the thing that you have promised. And if you understand that principle, we'll go into the details now, but if you understand that principle, you now understand IFRS 15. That's what the core is. That's how it works. Okay. Always exceptions. If you sell something to somebody that you're going to deliver over 12 months, but the moment the person walks out the room, you realize you made a mistake with the price, and you think you are going to make a loss. So I promised somebody I will provide them with a cleaning service, and then I walk into their house and I see how dirty their house is, and I realize I'm going to make a loss. Okay? I've got 12 months. I've got to do this for 12 months. I signed a contract. I'm stuck with it. But I didn't provide enough. What I've got to do is I've got to recognize the loss immediately. Okay. Again, I'm looking at the insurance guys and saying you'll be familiar with this onerous contracts concept, with this concepts we have in IFRS, which is a non-symmetrical. Recognize profit over time, recognize loss immediately. Take the bad news when it happens, recognize the profit only as you actually earn that profit. So IFRS 15 has what it calls a 5-step process. Now, I love the 5-step process. The 5-step process makes absolute sense to me. Every time I've ever spoken about IFRS 15, I use the 5-step process because it's the sensible way to think through the standard. Okay. I was at the ISB when we wrote the standard, and when we talked about it in the room, we talked about the 5-step process, but we never wrote it down. So nothing in the standard says step 1 or step 2 or step 3 or step 4. So you'll see as you work through the standard, if you read the standard, you'll see these core things come through, but they're not in the standard. But this is the right way to understand how the standard works. And I think the very first bit, you identify your contracts with the customers. So you want to know which are the contracts that you have with customers. Sometimes it's easy. Sometimes the contract with the customer is a contract that is signed, that is put in a drawer, that is there. Sometimes it's hard. Sometimes the contract is something that I have to identify through what we have talked about or what I verbally agreed on. Sometimes it is an instantaneous contract the moment I press sell on the till. Now I've got the contract. Now I've got to look into the contract and say, what did I promise I would deliver in this contract? What are the promises I made? Okay. And again, sometimes it's easy. Sometimes the promise is just the Lindt chocolate. But if anybody's ever read the contract that you got with your mobile phone, that's a long and detailed and complicated contract that goes on forever. So you might have to think sometimes about what your contract actually, what your promises are that you've actually made. Then we determine the price. So how much have I agreed I will be paid for this particular contract? Then we take the price and we allocate it to each of the promises. So Lindt chocolate, very simple. All price, the whole price is for one chocolate. Mobile phone company, and I don't know what it's like in North Macedonia, but if I think again about South Africa, in South Africa, I go and I sign, I get a free phone, free, we'll talk about free again just now. So they give me a phone for free, and then and then what I agree is for the next 2 years, I will pay a lot of money back to them. And for that money that I'm paying for them, I will get data and I'll get phone calls and and I have studied accountancy and law for 40 years. I've worked in banks and I've worked in insurance companies. I've written accounting standards, and I still do not understand my mobile phone contract. I still don't understand what I'm getting for free and what I'm getting charged for and what I can carry over and what I can't carry over. I give up. Okay. So there's a lot happening in that mobile phone contract. So when the mobile phone companies come to do number 4, it's hard. They know they're going to get paid money. They know they're going to get paid money over time. They know they're going to do different things. The only thing they really know for sure is a mobile phone just left the store. But that's all they know. And so when they do this calculation, they've got to do a really clever calculation about how they do this determination. And then, of course, the last one is I've got to recognize the profit. I've got to recognize the revenue when I have delivered on the performance obligation. So for the mobile phone company, I'll recognize some of it when I deliver the phone. I'll deliver some when I deliver first month's data, second month's data, third month's data, etc. I'm going to figure out a way to split this over time. All right. The first important thing here when you think about identifying the contract. So now we're talking about step 1, that very first thing we have to do. Okay, is you can only account for the contract when the parties are committed to their respective obligations. Well, let me go down all the way. So you can only do it when the parties are committed to what they're going to do. Again, I'm going to talk about a South African example. In South Africa, one of the products that is really, really popular is something called timeshare. So what happens with timeshare is I see a beautiful place on the beach, a nice holiday hotel or something, and I agree that I will buy 1 week in that hotel for the rest of my life. So I've agreed that I will pay something for that for the rest of my life. And this product is hard sold. So I will be walking around a shopping center and somebody will say to me, you come inside, we'll give you free pizza and you have to watch just a 15-minute video for free pizza. So I go in and I watch this video and this video is telling me how wonderful the product is and how you're going to love this place. And it shows the most magnificent views of what this place looks like. And they're feeding me pizza and they're giving me beer and I'm very happy. And right at the end, they say, just sign here. And I sign and I leave. Okay, now I have 1 week's timeshare for the rest of my life. Okay, at some place I probably don't know about. Because this is such a hard sell in South Africa, they've passed a law that says I have a 3-week cooling off period. If within the next 3 weeks I change my mind, I can walk away, no costs. I don't have to pay for the pizza or anything. Okay. I just walk away and say, sorry, I don't want to enter this transaction. In that circumstance, the timeshare company probably cannot say they have sold me yet, because they don't know until we've passed the 3-month point that I'm committed to the transaction, or the 3-week point. And I know timeshare companies in South Africa, the other one in South Africa that does a very similar thing is gyms. So they try to sell you lifetime memberships of gyms. And then they do this hard sell, especially around the 1st of January. And again, you've got a cooling off period. So from their perspective, they don't know that they've made the sale until it's actually past the 3-week point. In the case of gymnasiums, the South African gyms work on the principle that 80% of people who buy a gym membership on the 1st of January will not attend a gym after the end of January. They'll be there for 1 month and that'll be it, they're gone. Okay, that's the way they work, and that's the way the capacity works. They couldn't actually deal with it if everybody who signed actually came, because they didn't have space in the gym. So it gives you an idea. These are cases where you've got companies that are specifically saying, even though they've got a signature, even though they've got a sale, the parties aren't committed. You don't have a contract until both parties are committed to the transaction. You don't have a contract until you can identify exactly what the thing is that is sold. And there was an example, there was a question that came up that we'll answer a little bit later, that came up during the lunch break about IFRS 15, about what happens when you have a property sale. So I buy a flat, I buy an apartment in a building that has not yet been built. So what I've actually bought is a little hole in the air, okay, a little hole in the atmosphere that one of these days will be filled with bricks and things. But until it's filled with bricks and things, what I've bought is a little bit of oxygen. Okay, how do you treat that? What happens with that? So these are the types of things I need to be able to identify. I need to be able to identify how the person is going to be paid. What is the actual payment that happens? The contract must have commercial substance. So there must be a commercial reality to it. And you must expect that you will collect the consideration, that you'll collect the money. One of the little interesting tricks, this standard was a standard that was written by the IASB together with the US counterpart, the FASB. So we have an identical standard between the two countries. And so when you're having a conversation around a board table with your counterparts from America, you tend to learn a little bit about the American system. American healthcare, if you go and get healthcare, you will get an invoice. The invoice will say 1,000. Okay. If you then say, I have a healthcare provider, a healthcare insurer, a managed care insurer that covers me, the price goes from 1,000 to 600. Because the healthcare provider has said, we will only pay 600 for that service. So they just change the invoice, or they change the statement they send you. So even though they had an agreement with me on 1,000, as soon as they found that out, the price changes. So they have to think about the probability when they sell that, or they have to look at the probability of that they will actually collect the money. There are other services like the timeshare where the probability of collecting the money is less than 0, because you're not going to get it because people can back out of it. This is the assessment you make in step 1 to decide if you even have a contract. And if you do not have a contract, then you do not recognize anything until you've got your money and the transaction is not refundable. So We identify a contract. We say this contract has got so many uncertainties in it because the parties are not committed to it. Therefore, we do not think this is a contract. We don't recognize anything. If we're talking timeshare, even if I've received the money, what I'll do is I'll show that I've got a cash in the bank and I've got a liability because nothing has happened yet. And then when I get to the date that I no longer can be forced to refund, then I recognize the sale. So the recognition timing here is really important for revenue when you identify the contract. Okay. So I've actually seen in my life before these types of transactions. So we talked about KCC. We said earlier that it has a 30 June year. Well, we said earlier that it has some big international customers. In this particular case, we're assuming it's got a 30 June year end. So that's its specific year end. It speaks to one of its customers. The customer agrees to buy $1 million worth of inventory from KCC on credit. Okay, and in fact, there's a distinction there. You can see KCC's year end, for the sake of this example, is the 7th of July. The customer's year end is 30 June. So it sells inventory to the customer after the customer's year end, but before its own. Okay, and it says to the customer, you agree to buy $1 million of my excess inventory. Okay. I say that if you still have the inventory by the end of July, I promise I'll buy it back from you for the same $1 million. Okay. You have a choice if you want to keep it. But if at the end of the month you want to give it back to me, you give it back to me. That's your choice. Up to you. Do you think KCC can recognize revenue on the 7th of July? Okay. So a lot of people saying no. I can see it in the room. I can almost hear it online. We can see this is a scam. Okay. Why not? What test have I failed? Performance obligation. So my obligation under the contract is to deliver to you. Your obligation is to give me $1 million. Have we both met our obligations? Okay. Our secondary obligation here is that if you want to, at the end of the month, you can give it back to me and I'll give you back your $1 million. Is there anything you would say means I'm not going to meet my promise or you're not going to meet your promise? Feels to me like we've got promises and we both intend to keep the promises. I'll give you the stock now. I'll take back the stock in a month. I'll give you you give me the money now. I'll give you back the money at the end of the month. So we have a look at the first one. Are the parties committed to what they said they would do? And I think the answer is yes. They are committed to what the contract says they will do. That's not the problem. Okay. Can each identify their rights and obligations for the goods and services? Yep. We know it's $1 million. We know that it's underlying stock. We know what that is, so they can meet that one. Have we identified the payment terms? Yep, you pay me cash immediately. I pay you cash back in a month's time if we decide not to. Does the contract have commercial substance? Is this a sale? Doesn't feel like it, does it? Okay. It doesn't feel, and that's the thing we all reacted to. We all reacted to it. This feels, I said, this is a scam. Okay. We reacted to reading this and saying, but oh, this is not a real sale. Nobody sells anything and says you can give it back to me in a month's time and I'll give you all your money back. So that's the one that actually fails. Oh, let's just see. Sorry, what's going on here? I'll just roll it out. So what we've got here, I think the first one, yes. Second one, yes. Third one, yes. Fourth one, I'm not so sure. So the fourth one that says commercial substance, in fact, the commercial substance one I'd say is no. And the fifth one, I'm not so sure. We'll collect the initial consideration, but we have to give it back. If I have to give it back, I'd probably argue that's not real commercial consideration. So how would this work under the rules we've just talked about? I would say that I do not recognize the sale on the 7th of July. Okay. When I get to the 30th of July, if at that point it hasn't been given back to me, then I can recognize the sale. Should we have a look at a couple of these examples? Can we do one online where people can answer more than one? Yeah, so we've got 4 choices and they can answer 1, 3, and 5 as 1, 3, and 4. Okay, so on this one, I'm just asking here whether these are sales contracts as we think about them. Okay, so the question for those online, and you can have more than one, you can say yes to more than one. Which one of these 4 are sales? Okay, and we'll walk through them slowly. So the first one, I sell unbranded coffee beans. So normally I sell my coffee beans, it's under a brand, but I sell unbranded coffee beans for cash to street vendors. Do you do this here where you have the guy on the street corner and he sells coffee to you off the back of his back? In traffic jams? Yeah? No. No. Okay. Okay, you get that a lot in South Africa. I know you get it in Armenia too. So you can actually buy a little coffee at the traffic light. Okay, so the first one, is that sales, do you think? Okay, it doesn't matter who you sell it to. Doesn't matter how you sell it. Your ordinary course of your business is selling coffee beans. So again, the people online probably agree with that one as well. So that looks like more yeses for that one than for some of the others. Unbranded excess stock. So I've just got more coffee than I know what to do with. Normally I would sell it to, now I'm selling it to the local roastery. Well, if we said yes to the first one, the second one must also be sales. We agree exchange beans, we've already spoken about that one actually. So we said that's not a sale because all I'm doing is I'm exchanging with somebody else. How about the fourth one? I provide coffee beans to my local IT company in return for IT services. So instead of giving them cash, I give them coffee beans. Do you think that's sales? Agreed? Okay. So if I have a look online, looking at the guys online, I think everybody got the first one right. Not so sure about the second one. Not so sure about the third and the fourth. It might be because they're working through them slowly as we go. So maybe they'll catch up with us here. So the big point here is that when I look at these ones, on question 1, it's obvious, it's normal sales. On question 2, it's obvious, it's normal sales. On question 3, we've already covered it, but it cannot be sales if it is just a swap like for like. The fourth one is probably the tricky one in this one, because that is also a swap, but it's not like for like anymore. I am paying for an IT service, but instead of using cash, I'm selling them coffee. It's 2 different transactions that I treat as one. They will show a sale in their books, and we will show a sale in our books. That's how you recognize revenue on that one. Okay, thank you. Okay. So I think let's jump to slide 34. Well, we got the answers up, so we might as well talk. Those are exactly the ones we've just spoken about. So let's move on to the next one. Thank you. All right. So that's step 1. Step 1 was about identifying whether I have a contract for the sale of something to a customer. And the easy principle there is it's kind of a yes-no thing. I just decide whether I'm in that space. Step 2 is I need to identify the performance obligations. I need to identify the things that I have promised to my customer I will deliver to my customer. There are 2 rules around this, or 2 requirements around this. Firstly, the thing that I have sold to my customer must be something the customer can benefit from, okay, either on its own or together with things that are readily available. Okay. So it's interesting, if I go back to the example earlier about the apartment, and I said when I sold the apartment, when I bought the apartment that was still being constructed, I bought this hole in the air at the moment. Now, I can't benefit from that hole in the air until something has been built around it. They can't build my apartment there, and the one underneath me didn't sell, so they won't build that one. I can only benefit within the context of the whole structure. I can't benefit from that one individual thing. And you think about that quite a lot. If I am buying a house that will only be delivered to me at some point in the future, okay, I can't benefit from the wall they have built now on that house. I can only benefit when it gets delivered to me in the future. But if I contract with somebody to come and build at my house now, okay, and they build the wall, even though they got to build the room, they build the wall, I can benefit from that room on its own, from that wall on its own, because the wall is already built on the property that belongs to me. So I've got to think about, can I benefit from this thing? I've got to answer the question, can it stand on its own? If the answer is yes, or I can get other services that make it beneficial, that are freely available, then it is a separate service. It's something separate on its own. And is there also a significant service provided by the counterparty that pulls things together, that makes things work together? Now, I'm going to give you a couple of examples here because this is quite difficult to understand in the abstract. And I'm going to go back to the mobile phone company. If I think about a mobile phone company and I think about just two things that I'm going to get a phone and I'm going to get access to the network. Okay, so there are two separate things. Could I benefit from the phone on its own or together with other things that are readily available? And the answer is yes, I can. Because I can take that phone and I can go, if this mobile phone company goes bankrupt, I can take the phone and I can go register with another network. Okay. Could I benefit from the network services on their own without the phone? Yes, I can, because I just get another phone and I link it into the network. I put the SIM card in. So I can benefit from those two things together. They are related to each other. You have satellite TV in North Macedonia. Do you buy a satellite box or do you get a satellite box from the company? Okay. Can you use that satellite box with any other satellite service? No. Okay. So you cannot benefit from its own, can you? It's useless on its own. You throw it away. If the company goes bankrupt, you throw the box away. So in that case, you haven't received something separately. What you've received is something that facilitates your ability to get the thing you're actually paying for. Okay. So in that case, with the satellite company, I'd say this is a single thing all the way, end of story. When I'm thinking about the mobile phone company, I would say there are two things, the company and the network. And I have to think about performance obligations that way. Just thinking about whether or not I can use them on their own, I can use them without interaction. There are then specific things. So we think about what is separate. Now, in fact, I'm going to go back to one example before I move on from this one. Again, question for you about North Macedonia. If you buy a Mercedes, okay, does the Mercedes come with a service plan where they will do a free service for 5 years for you? Okay. So again, I've bought two separate things, haven't I? I've bought the Mercedes. Okay. Then I have bought something separate, which is the service. The service is separate because I could take that Mercedes to somebody else to do the service for me if I wanted to. So it's two separate services. So I would recognize it and I would say, there's a vehicle and there's a service plan, and the two go together. Okay, so we're happy, we got that. So then I walk on to a warranty, and I will say, what is a warranty? A warranty is sort of like the service plan. It says that if I am buying this, if I'm buying this car, the company is telling me the car will work for 5 years. So how's that different from a service plan? The standard says there is a difference. It says that a normal warranty is simply telling you that the thing you bought will do what the thing you bought is supposed to. It's not separate. It's not separable. It is part of that thing you bought. Okay. So if it is the normal promise, it is not a separate obligation. You don't think about it as a separate obligation. So you have sold the car with the warranty. Everything is one bundle. On whatever day you deliver the car, you deliver the promise that the car will operate. But if you buy a special warranty, what in South Africa is called an extended warranty, that's an add-on service. So now I'm promising you something that goes beyond just the normal. And so now I've got two things. I have sold you the vehicle, maybe with a normal warranty, and then I've sold you a second performance obligation, which is the extended warranty. So the standard differentiates between these two. So you see, one of the tricky things with IFRS 15 is going to be just identifying what the different things are that you promised. What are these different elements that you promised to the company, to your customer, that you'll deliver to your customer? I'm sort of scared of this example. I just want to see, okay. All right. So looking at this example, we sold farm equipment. We said we sell farm equipment to our suppliers. I think we said in Ethiopia. We sell them the machinery. We sell them a standard manufacturer's warranty. Okay, so just the standard warranty that goes with it. We sell an extended warranty that KCC underwrites themselves. So they will say they'll look after it if it goes bad after a certain period of time. We give them 40 hours in-person training on how to operate the machinery. Okay, and we extend them credit terms. We say to them they only have to pay this over 5 years. Okay. We often sell these machines without the training services. We often sell them without the extended warranties. These are all added extras that you can choose you want to add on to the process. So, whoopsie daisy. Which of these would you think are separate obligations? Okay, which of these are separate? Which of these do you have to combine? So we just have a look through. The machinery, separate. Everybody happy? Everybody online, I'm hoping you're listening in. So everybody happy, the machinery is separate. It's something we can see. The standard warranty, part of the same thing. And we've said that that's the rule in the standard. The standard says the warranty is treated the same. What about the extended warranty? Separate. So it's a separate thing I've sold. Okay, the 40 hours in training, separate. It's a service that I am providing to the customer. Extended credit terms. It's a separate thing, isn't it? It's not part of the bundle. Now, I might not even treat that as revenue because that's a credit thing, but it's not part of the sale thing. I've decided something separate for each of these steps. If you have a look at these, all of these, and I hope the next slide says the same. Yes, it does. Okay. So all of those are separate things that I am selling to my customer on the basis of separate obligations that I need to determine. Okay, I just want to check. Yeah. Okay. The next step. So step 1, we identified the contract. Step 2, we identified what we have promised to deliver under the contract. Step 3, we need to determine the price. Okay. And again, a lot of this stuff sounds really complicated, but when you think about it, most of the transactions you do are very, very simple. When I bought the Lindt chocolate, okay, did we know what the price was? Heck yeah, we know exactly what the price is. It rang up on the till, it's the same amount that's paid, everything happens immediately, no questions asked. But in real life, there are transactions that are going to be more complicated. And the first one you have to think about is variable consideration. What happens when I don't know how much the price will be because it is variable for some reason? So when I spoke to you earlier, I mentioned the hospital case in the US. And I said, okay, they put an invoice. The invoice says 1,000. But do I know that 1,000 is the number? Or do I think it might be 600? Or do I not know at all? So the question here is, I need to determine with reasonable, I need to be highly certain that the revenue will not reverse when the uncertainty is involved. So even if the person pays 1,000, if I do not know, I cannot be certain it's highly probable. I would only recognize 600 until I knew it was highly probable. So I've got to wait until the uncertainty unwinds itself for variable consideration. And thinking about variable consideration, thinking about when something is highly probable, the factors you need to think about is whether the actions are within your control. So let me take an example here. I promise you that I am selling you a painting, and I will deliver the painting to you on the weekend. Okay. The condition is variable. The sale is variable. I will only get paid if I deliver. Okay. But delivery is under my control. Okay. It's my deal. I have to manage delivery. So I would probably say in that circumstance, it's highly probable that there will not be a reversal. It's highly probable I will receive the money because I'll make the delivery. What is my experience with similar types of contracts? I think one of the big issues around particularly a company like Amazon these days is that they sell, they arrange for the delivery happens, but there's still 24 hours for the counterparty to return the product. Okay. In that case, they might look at their experience. I was reading the other day about somebody who sold Halloween costumes, you know, dress up like a pumpkin or whatever. We're selling Halloween costumes on Amazon the day before Halloween, and then the next day it all got returned. Okay, it's a bad business model, let's be honest. But I mean, the reality is that person in going through this would say, it's out of my control. Amazon insists that I have a returns policy and that I provide people with 24 hours. For all of the sales that happened on the same day as Halloween, reality tells me it's out of my control. There's probably going to be a high level of returns. So I move into the next one and I'll say, what is my level of experience? What do I normally expect the returns to be as part of this process? And then length of time before the uncertainty is resolved. Yes. Oh, sorry. I thought I heard a question. Okay. Length of time before the uncertainty is resolved is also important. When you look at contracts, and the ones that we see most regularly, again, using South Africa as an example, is investment contracts. So investment contracts, I take a contract with an insurance company in South Africa. So I'm going to give you $1 million. You've got to invest this for me. The insurance company says, fine. They will take 10% of the return every year. Okay. Subject to the fact that if there's a loss, I claw back the fees I've paid. So if I make a big profit in the first year, I pay the 10%. Then there's a loss in the second year. Some of that profit disappears. They have to pay me back the fee they charged me in the first year. And that goes on for 5 years. And at the end of 5 years, the amount I would have paid them in 5 years is 10% of the net profit over 5 years. In that case, I go through that measure and I say, well, I might argue that the first one, okay, is outside of their control. They can't control what the markets do. They can control to some extent what their investment strategy is, but they can't control what the markets do. Their level of experience with similar contracts is probably that markets go up and down, and sometimes you win and sometimes you lose. More often you win, and it's going to take 5 years for the uncertainty to be resolved. They may conclude that they cannot recognize any profit until the 5th year, because that's how long it takes to unwind. Which is why they now write the contracts differently, which is interesting. This and mobile phone companies, so investment managers and mobile phone companies, are the two that have very often tweaked their model a little bit. So what the investment companies now do is they usually have a fixed portion, say 5% of capital value can't be clawed back, and the rest is discretionary. The mobile phone companies, and again, I don't know if this is happening in North Macedonia, but now in South Africa, my mobile phone company says, this is how much the handset cost, and this is how much of your monthly payment is for the device, and this is how much is for the for the services. And that was a change that came in after this standard came in. A lot of mobile phone companies went from a single number to actually now splitting it, because that makes sense for what they're doing. It's the way the accounting now reflects what the contracts actually say. The next one that's really important is significant financing. So if somebody pays me today, that is different from if somebody says, I will pay you in 2 years' time. If somebody pays me today, but I deliver them the service in 2 years' time, that is different from if somebody pays me today and I deliver the service today. Financing is when there is a disconnect between when the money flows and when the service or goods flow. So when the accompanying service goes. And what you've got to think about when you're looking at that is, firstly, do you charge a different price for people who pay cash versus people who pay on credit? If there's a different price, that is probably the cost of the financing. You've got to think about what is the effect of time value of money. So if I get paid in 10 years' time for something I gave today, there is an effect of time value of money, and it's going to be material. I need to consider that in the process. But none of this works if delivery is at the discretion of the customer. So if the customer says to you, I pay you today, I'm only going to take delivery in a year's time, I would say, well, the customer is actually giving me credit. They are lending me money for 1 year before I deliver the product. But if the customer says, I'm giving you the money today because I want to buy the sofa, but I haven't finished painting the room yet, so I will let you know when you deliver. Okay, that's the discretion of the customer, and you would ignore it because this has got nothing to do with financing. It's got to do with the convenience of the customer. And then there's a practical expedient, and you see this come through a lot in IFRS, is if there's a less than a 1 year difference between delivery of the goods and the payment of the money, you are allowed to ignore it. Allowed, not required. So when we spoke some of the examples, like the Tesla example that sells on credit, maybe Tesla really wants to recognize 2 different sources of profit. But for other circumstances, what you want to say is, okay, it's easier not to go through the fuss of doing this. It's easier not to have this process and worry about it. Okay, so I'm going to ask one quick question here, and then we can go for a coffee break. So the question is, and if we can set up there for the last question before coffee. So a prepaid card entitles a customer to 100 hours of airtime. So I can use 100 hours of airtime. I prepay for the card using a specific telco's network. The card expires 2 years after purchase. So I have to use that telco, I have to use that airtime within 2 years. I pay up front for it, okay? Does it have a significant financial component or financing component in it? Now what I've paid now, it's 2 years contract, okay? So there's quite a long period of time. So what do you think? Do we say yes? Yes, it does have significant financing because it's 2 years, okay? No, it doesn't have significant financing for whatever reason, okay? Or 3, it actually depends on other things that are not on the slide. What do you guys think? And don't cheat and look at what they're saying online. Yes? Okay, depends. Okay, so we've got a few yeses, a few depends. I don't hear any no's. And online is so evenly split, it's just not funny, isn't it? Okay. I think let's stop the online one and let's see. So that's pretty much a nice split for online, virtually one of each of them. Okay. When is the customer going to use the airtime? Whenever they want. They can use it all tomorrow. Okay. They can use it on the last day of the 2 years, They can use it in between. So if we go back to the requirements here, we said if it is at the discretion, if delivery is at the discretion of the customer, then it is not financing. So our answer here would be this example, it is not financing because the customer chooses when they use the product. So even though they paid up front, they could have used it all that same day. They could, well, 100 hours of talking in what my wife could. 100 hours of talking in one day is going to be hard, but they could have used it all in the first 3 days. Okay, or the first 5 days. Okay. So the reality is we don't know when they're going to use it because they have a choice. Therefore, we do not consider it financing. Okay. I'm going to stop there just to remind you we've done 3 steps, identified the contract, identified the performance obligations. We're now talking a little bit about identifying the pricing. I'm going to go into a little bit of math straight after the break where we just think about how we identify the effect of financing, and then we'll walk on to the other steps. Okay, I think we're mostly settled on. I hope everybody's back online. So we're going to carry on from where we stopped at the end of the previous, just before coffee. What we said just before coffee is if I'm trying to determine a transaction price, and in thinking about that transaction price, I have significant financing, then I need to adjust the price to reflect that financing. Okay, so I need to think about what the price is, significant financing. And the way I think about that very simply is money today is worth more than money in the future. So we always know that I'd rather get the money today than get the cash in 2 years' time. Therefore, if I get the money today for a service I'm delivering in 2 years' time, I have a significant benefit that is financing to me. If I deliver the service today and I'm only going to get the money in 2 years' time, I have given significant financing. I've given a benefit to the counterparty, and I need to take that into consideration. So you would use a discount rate that you would use if this were a separate transaction. So if I made a separate decision that I would sell you something and then separately I would lend you money, the interest rate that I'm going to use to do this maths is how much would that interest rate be if I were to lend you money? Now, again, this is not necessarily something you have to go look for. Often the information is already in the agreements you have. If you charge one person a cash price and somebody else a credit price, the difference between those two probably reflects your interest rate. If you sometimes in some contracts, you will actually put into the contract that interest accrues at 1% a month or 10% a year. The information is actually put into the contract. So you may be able to get the information directly from the contract, but if you can't, you will typically use what's called your incremental borrowing rate. This is the rate that I, as a company, would borrow money at. That's the rate I charge my customers if I don't have more science than that. And once you've set the rate, you live with that rate. So if I decide it's 10%, it stays 10%. I don't adjust it every time there's a change in interest rates. I set the rate and it's done. So just a very simple example here. I've got a company, KCC sells a contract, enters into a contract to sell to a customer 1 ton of coffee beans in 2 years' time. So they agree that they will sell it to the customer, delivery in 2 years' time. They get a payment right away of $1 million. Okay, subject to the agreement that whatever the price is in 2 years' time, they will true up the amount. They'll either pay a little bit more, a little bit less at that point in the future. You can already see that they're giving a little bit of a discount, so it's 95% of the normal price. Okay, so that tells you something about what's happening here. They're giving a discount because they're getting the cash first and they only have to deliver later. But their own incremental borrowing rate is 10%. So now we've got a difference in rates. Okay. So when you look at this and you say, well, the 95% probably contains other things. It contains the premium for doing business on that basis. It contains the risk that you're taking in terms of them giving your money up front and the like. So the more realistic interest rate here is probably the 10%. It reflects what you would do a deal with in the market. So what have I got? I've got $1 million flowing one way. I promise I will deliver something in the future. In 2 years' time, I will deliver these coffee beans. I've got the cash in my pocket, so I already have received the money. So that's the transaction. What do I recognize? Goran, if we can put the questionnaire up. So it's I think it's an A to D. So revenue, do I recognize revenue of $1 million? Because I've got the cash has come in, I've got $1 million. Or do I recognize revenue of $1.2 million, which is $1 million plus 10% for the first year, which is 1.1, and then another 10% for the second year, which is 1.21 million. So that's how much I expect to receive for this contract. That's the value of this contract for me. Or do I recognize revenue of 1.052? That is the revenue I would recognize if I was just selling this under normal conditions. No discount, no 95%. I'm selling it for 1.052 is my normal selling price. Or do I reflect a financial liability? Okay. So we're asking everybody online for those four. It looks like we got a mixed. Oh, we're still getting a new one up there. So what do you think in the room of those four options? 3? D. No sale. Everybody happy with that one? Let's see what's happening with the guys online. Oh, there they come. Yeah, they come. Oh, it looks like D. Everybody likes D. Okay, so this was actually too easy then, obviously. Okay. What do you think? So I said everybody likes D, but now there's some dissension in the ranks here. Okay, so there's two questions maybe you need to ask. The first one is, what is the transaction price? Okay, so let me just ask that. What is the transaction price? There's three different prices there: $1 million, 1.21 million, or 1.052. What do you think the transaction price is while everybody's answering the revenue question? What have I actually agreed with the party they will pay me in real money for the coffee beans? Okay, I've heard A, I've heard C. Okay, so the real answer here, economically, it is B. Why is it B? Because I've received $1 million now for a sale in 2 years' time. How much is $1 million today in 2 years' time money? It's 1.21 million. So they've given me free credit for 2 years. That means the sales price, the price at which the sale will be recognized, is 1.21 million. But will I recognize revenue? No. Because remember what we said, I only recognize revenue when I have performed. What do I need to do to perform here? I need to deliver coffee beans. I haven't delivered anything. So the answer is actually a mixture of these. I will not recognize revenue now because nothing has happened. But in 2 years' time, when I give them the coffee, I will recognize 1.2 million. Because I will recognize the benefit that I have received from receiving the money early. Make sense?
We make separate financial operating incomes.
So essentially you would. This is what you're going to do. And let me show you quickly. What I'm going to do is I'm going to bounce ahead a couple of, because of, here we go. I'm an accountant, and the only way I can think is in journal entries. Okay. So what happens? What does my journal entry look like? My very first journal entry is I received cash. Okay. Can't stop that. The money goes in the bank. Sorry, guys, I've got this problem again. Let me do that. My very first entry is I received cash. There is money in the bank. I cannot deny that there's money in the bank. But I have not done anything to earn that money. I have not done a thing yet to earn that money. So what I've got to do is I've got to say that if I still do nothing in 2 years' time, I will have to give the money back. So I record a liability of 1 million. So 1 million of cash, 1 million because I will have to give the money back because I have not performed the service. End of the first year, I say, well, what's happened? I've had free money for a year, but nothing in life is free. So economically, we say I've paid something for the money. So I recognize that I've got interest paid of 100,000. In my expense, in my profit and loss, in my financial statements, I will show an expense of 100,000, and I will increase my liability by 100,000. So now I've got a liability of 1.1. I've got an expense in the current period. Next year comes along, okay? End of the second year, I recognize more interest, 10% again, but now it's on a balance of 1.1 million. So I have interest expense again, and a liability of 110,000 increases. Now my liability has gone 1 million, the original, plus interest in 1 year of 100,000, plus interest in year 2 of 110,000. I've got a liability of 1.21, and then I deliver the coffee beans. Okay. Now I have settled my obligation at the end of year 2. The liability disappears. I don't know anybody anything, and I recognize revenue of 1.21 million. In my income statement in year 1, interest expense only. Interest expense only. In my income statement year 2, interest expense of 110,000, revenue of 1.21 million. I'm recognizing the value of the money I received, and because I received it early, it has a higher value than if I recognize it late. Does this make sense to everybody? Yes.
We have the microphone,
Oh,
yes.
sorry.
End of the first year or end of the second year?
So we said in this,
When we have the revenue,
we have the revenue when we deliver the coffee beans.
in the first of,
And what we said is we will only deliver the coffee beans in 2 years' time.
but on the slide is end of the first year.
Ah, okay. Is that the problem? Okay.
No, the last, no, the last one.
Oh, okay. Let's go here. So the journal entry there.
It's okay. No, another.
Next one.
Another, yes.
Ah, sorry, end of second year.
Thank
Thank
you.
you. Yes, end of second year, yes. So sorry, yes, that should be end of second
This
year. I
is
recognize
technically,
revenue.
we understand it is in the second year.
Perfect, yes. Thank you. Okay. So you can see what we're doing here is we are adjusting to recognize the revenue when we deliver. We're saying what is the value of that revenue when we deliver. This is how we adjust for financing effect. Normally, financing works the other way around. I deliver first, I get my money later. Yes, sir.
I don't know whether I correctly understood, but these expenses are actually liabilities for the interest. They are recognized as interest expense during the first and during the second year. And then at the end of the second year, in operating income, this interest expense, which is financing expense, is through operating income neutralized this effect of the interest expense.
But in 2 different places. So interest expense goes through financing, because that's where interest expense goes through. That makes my revenue bigger. The revenue comes through operating. And it's reflecting the fact that I have a financing transaction. Because what have I done in this transaction? I've borrowed money from my customer for 2 years. At the end of 2 years, I've given them something for the borrowed money. And that's what you're recognizing. But you're absolutely right. Geography, some will be in financing, and that will make the top, and then the 2 set off like that.
Excuse me?
Yes.
For Macedonian slide also have the some wrong errors. Debit is Dolji and credit is Pobarova. Is the different columns.
Okay.
Thank you.
We'll pick up on that. So I must read the debit and credit in English, not in Macedonian. Okay. So what have we done so far? So far we've said we have a contract, we've identified the contract. Second step, we said we have made promises in the contract, we've identified the promises. Step 3, we've identified the price, and we've had to adjust the price for time value of money if it's out of sync. The fourth step is to now take that price and allocate the price to the promises. So how do I allocate the price to the promises? And if I think about it, the standard gives you 3 different methods that you can do it. What you can do is you can go and say, if I sold those things separately, what would the separate price be? So let's think about the mobile phone company. If I sold you a phone and I sold you network, all as part of one contract, what would be the separate price for the phone if I was selling it? What would be the separate price of the network? And then I would split the money I'm receiving and say, if I'm receiving 90% of the total separate price, I'd say 90% of the network is what I've received, 90% of the mobile phone is what I've received. And this explains to some extent why the mobile companies have said, this is just simpler, we're just going to put it on our invoice so that you can see it. So they've started to put the separate prices on. Think again about the Mercedes you bought. You buy the Mercedes, you pay for the Mercedes, you don't pay for the service plan. You get a price and you get a 5-year service plan. So what Mercedes must do is say how much of that price is for the car, how much of that price is for the service plan. The way they would do that is they would say, if I sold the car without a service plan, what would the price be? If I sold the service plan without the car, what would the price be? And I do that comparison. But that doesn't always work because you don't always have the ability to sell things separately. So maybe Mercedes can't sell service plans without motor cars. The service plan always goes with the car. So they don't know what the price is. Then the typical approach that's used is what's called the expected cost approach. So I say, how much do I expect the services will cost me? How much do I expect the car will cost me? What is my margin on these 2 pieces? How much is my profit margin? And then I give a profit margin that is the same to both. So I determine the price by taking the profit margin. And the last one is the residual approach. All I do is I take the ones I know. So if I sell Mercedeses with plans and I sell Mercedeses without plans, I say, well, the Mercedeses without plans, I know what that price is. That's the one I'll attach to the ones that have got plans, and everything else must be for the service plan. So there's a couple of different ways you can think about it. But again, you can see here how these things become quite complicated quite quickly, and why the mobile phone companies, for example, changed their contracts to make it simpler, because they didn't really themselves quite understand where all the money was going to and how it was working. Okay, so all we've done here is we've now, as I say, we've taken the price, we've adjusted the price, or we've, allocated the price to the individual things. We've talked through all of that, so I can jump straight on. And I'm not going to go through an example. Well, let me just show you an example. So you've got an example here where we sold specialist farming equipment. The contract provides the customer with all of these things. We're selling it to the customer for 3 million. If we sold it to the company at its individual price, we would sell it to the customer for 2.9 for the machinery, et cetera, and we would actually charge the customer 3.3 million if we're selling it, if we are selling it each individually. So all you're going to do is you're going to just apportion it between them. You just split it up between each of the elements. So the approach here is relatively simple. It's relatively obvious. almost everybody I speak to uses this methodology. So they just use a proportional methodology because they can usually determine a price. It's the simplest way of doing things. Last step. So we've done the contract, we've done the promises, we've done the price, we've split the price to the promises. The last step, which sounds like it should be the absolute easiest one, is we say, let us just allocate the price to the promise. Okay. And that is going to be very simple most of the time. So again, if I think through the examples we've been using, the mobile is a physical thing. I allocate a price to it. When is the mobile delivered? The moment I walk out the door, because I have the mobile in my pocket. Allocate the price to the network. When is the network provided? It's provided over time. So I receive some of it in the first month, some in the second month, some in the third month, etc. And I recognize that revenue over 12 months. With the Mercedes, or over 24 months. With the Mercedes, I allocate the price to the car. When the car drives out the showroom, I recognize the revenue. I allocate the rest of the price to the service plan. Now I don't recognize it over time because there's something that actually happens. When the customer brings the car for a service, I do the service, I allocate 1/5 of the price. When they come back a year later for a service, I allocate the next 1/5, all the way down until I've allocated the whole price. So you can see essentially it's based on the underlying thing that I'm delivering and when I deliver that underlying thing. Relatively easy to think about, but it does get complex with some contracts as you move along. The sale or the transfer or the performance obligation happens when control passes from me to the customer. So the point at which the customer takes possession of the thing that they are going to use. Okay, so let's think about that again. The motor car, as soon as the customer drives the motor car out, the customer has control of the motor car. The mobile phone, as soon as the customer puts the mobile phone in their pocket, the customer has control of the mobile phone. Now let's think about something like a construction contract. The company that is selling let's say the house, okay, selling the house, if they are selling the house, or if they're building the house, they're not selling it, they're building the house and they're going to give it to me. If they are building the house on my land, okay, I have control from the very first brick that goes down because it is on my land. So the transfer is happening over time. Okay. If this house is being built on their land, they have control. No, sorry, let's turn it around. If I am the builder and I am building on your land, you have control of the house. Okay. Because every brick that goes down is yours. You can fire me tomorrow and get another builder to come and finish the job. If I disappear and walk away, you still got the house, you can finish the job. So what we would say is my revenue, I'm recognizing over time. If on the other hand, I am building you a house on my land, okay, then I have control the whole time. As I'm building the house is getting bigger, but it is still on my land and I have control. And it only transfers to you when we sign a deed and the house transfers across. In that case, I will recognize no revenue while I'm building the house. And the revenue will only happen on the day that I transfer the house to you. Because it is on that day that you now have control over the thing that I'm building. And this happens the same when we think about that space in the sky where the apartment's going to be built. I have no control over that space in the sky until it's built. So in that case, in most circumstances, there are some rules that can change that, but in most circumstances, That building that I, the construction company, are building remains my building. I show no revenue, no revenue, no revenue until I get to a point over here. And at this point, I say, here are the deeds. It is now your property because it is there, it is built, it's up. Then that's when I recognize revenue for the first time. So part of this is thinking about what type of revenue are you earning. That helps you understand when you recognize revenue. And the way to do this is, when do I transfer the thing? When do I transfer the obligation to you? Okay. Now that's with a control model. I just want to have a look and see where I am. There are other examples you need to think about. So the control model works if there is a thing. But in other cases, think about the cell phone and the cell phone and the network. You as the customer never control the network. The network is provided to you. But what happens with a network is you consume it. So you receive your 1 day of network, it's consumed. Next day, consumed. If you think about something like a cleaning service, okay, people come in, they clean your house. There's no transfer of asset. There's no control of an asset. You come in, your house is dirty, your house is clean. You have consumed that service over time. And the same thing works for a lot of services. So what we're thinking about here is we're trying to think about the difference between whether something is transferred in one go, bang, I recognize all of it immediately, or whether it is recognized over time. And the test that I will think about is the test of control. Do I control the thing over time, or do I only control it at the end? And I think about consumption. Do I get the benefit immediately as it comes in, as I'm receiving it? It's also important that you think about whether or not you are getting something. So I'm trying to think of a good example of this. If a company comes in and does a particular service for you, and I think the one that's quite awkward in this space might be an audit service. So if you have a company that comes and delivers an audit for you, okay, in theory, I would say I'm getting a service and I'm consuming it as I go along. And I'm getting the benefit of that audit as I go along. But chances are, if I fire my auditor when they are 3/4 of the way through, and I employ a new auditor, the new auditor is going to start again. So I get no benefit from the work they've done. So the question then becomes, can the auditor recognize their income as you go along? Or do they have to wait to the end and they say, I'm delivering to you my audit report? And then when I deliver the audit report, it is that single thing that gives you the benefit. The way this is typically thought about is you now need to look at the next level or the next question and say, can the auditor demand their money even if you fire them? So if I fire my auditor, can they demand the money for the work they've done? Typically, you might need to go look at what your audit contract says, but typically the answer is yes, they can, in which case they can recognize the revenue. So even though they're even though they're only really transferring something at the end, the contract recognizes that benefit is transferred over time, and so they would recognize revenue over time with the process. Okay, it was easy till now, wasn't it? And then suddenly it got hard. Okay, and again, it's one of those ones that if you think about the concept of goods versus services, it's often very simple. I know what a good is. The chocolate was a good. The car is a good. I know what a service is. The network is a service. The satellite provision is a service. The repairs to my motor vehicle are a service. But when you try to define these things in a standard, it becomes a lot harder. But the key principles to take away from it at this stage are, we recognize point in time. If it is delivered immediately, we recognize the whole revenue when that happens. If it's delivered over time, we recognize the revenue proportionally over the time as we deliver. I'm going to go in here. Okay. So again, maybe an example here for you to have a look at. And what I'm thinking, well, let's have a look and just see in terms of point in time and over time. Farm machinery, point in time, physical delivery. Okay. Manufacturer's warranty. Ordinarily, a warranty is over time, isn't it? Because what am I saying? I'm saying that this will happen over time as it delivers. But remember way back when, before lunch, before the tea break, when we talked about a warranty, we said a warranty says that the thing I have given you is proper. It's the right thing. Okay. I'm not giving you insurance. I'm not giving you, I'm just saying this table is a working table. It's not broken. It's a promise I'm making you now. Therefore, a warranty is point in time. And you'd recognize an ordinary warranty at the time you've given it. Extended warranty, over time. That's special. It's saying, I will say, maybe in 5 years, from 5 years to 10 years or something like that, some point in the future, I'm saying over and above telling you that this will work the way it's promised. I'm now selling you insurance. I'm now selling you insurance that it will continue to work even after that. And that is a separate service that I'm offering you in the period when you get the benefit. You'll get the benefit of that from year 5 to year 10. And so you'll recognize the revenue in year 5 to year 10. Training, when you give it. Okay, so it's a little bit over time if you think about it. If you're giving 40 days worth of training, then it's going to be over 40 days. But when you've done 1 day, revenue recognized, it's done. 2 days, revenue recognized when it's done. You think about it that way. Yes. Won't you use the microphone? Microphone?
Sorry, is that training free or they have to pay a bit that training?
In this example, and obviously it can be both, but in this example, the training is free. But I come back to the thing, nothing is free. Okay. Nobody ever gives you anything for free. So when we went back to step, I think 3, we said we have, step 4, we said even for the free stuff, we must allocate a cost. How much would we sell it for? And then once I've allocated the price for the thing that's not free, then I'm going to say, when I deliver it, I will recognize the profit. So I said, I'm selling you one thing for $3 million. But in there is free training. Then we said a few pages later, what did we do? We took the free training and we said, actually, some of that $3 million is for the training. So we said 40,000 is for the training. Therefore, when the training happens is when I recognize the 40,000. So say if you start with a couple of principles, and one of the key principles with IFRS 15 is nothing is free. You remember that, you're already off to a good start. Nobody gives anything for free. Okay, I said IFRS 15 deals with 2 things. We said when we looked at the top of the income statement, we said it deals with revenue. Then the next line down on the income statement, it deals with cost of sales. Okay, cost of sales side just talks a little bit about the individual elements that you need to think about. It's not covered very extensively in IFRS 15. And it's fair to say that generally speaking, expenses aren't dealt with very clearly in IFRS. So this is probably the most detail you have on expenses anywhere in the IFRS family. So what do we say about contract costs? You can recognize an asset for costs. So let's think about the example. I'm building a house for you, okay, but I'm building it on my property, so I don't recognize anything. So as I build the house, I'm building an asset. I'm accumulating an asset that I recognize. So if any of those expenses are incremental, expenses that are incurred before the sale is recognized, then I can recognize an asset if it is incremental, if it relates directly to that specific item of revenue that I'm going to get, and if I expect to recover it. Okay, so I need those two things to be in play here. Now, the biggest example here is always commission. So I sell something, I say on the basis of this thing that I've sold, I will pay you a commission of 1%. The sale has not yet been recognized in the financial statements. I don't have to expense the commission immediately. I recognize the commission as an asset, and I will only expense the commission when the sale happens at some point in the future. And that's permitted, subject to it being incremental and expected to be recovered. And sorry, the bottom one there is important, is if you don't want to bother with this, and it's less than a year, you can just expense it. So you don't have to capitalize it and hold it. You can expense it immediately if it's going to be less than a year. Cost to fulfill a contract, if those costs don't fall within another IFRS. Now, let me give you the most obvious example, going back to if I am building something for you. I'm building a house and I'm only going to sell you the house at the end of the contract. Or I'm only going to recognize revenue at the end of the contract. This thing I'm building is probably under IS2. It probably counts as inventory. But if I assume for some reason it doesn't, I can recognize it as an asset if it relates directly to a contract. So I can point to a contract, and again, I'll give you an example here, and I expect it to be recovered. So let's think about the audit fees example we used earlier. I'm busy doing the work on the audit, okay? I'm expensing money on the audit. My deal with you on the audit is you will pay once I deliver the audit report to you. So right now what's happening is I'm building up an expense. I can capitalize that expense if I expect that I will receive, if I expect it relates to a specific contract, I can identify the contract. It relates to this performance I'm going to do in the future, which is deliver the contract to you, and I expect to recover it. That is assuming I have decided that I cannot recognize revenue along the way. If I've decided I can recognize revenue, what am I going to do? I'm going to say, I'm making a 50% profit margin on this, so I'll recognize the expense of 50, I recognize the revenue of 100. Then I spend another 50, I recognize another 100, and I do that over time. I'm not going to go into the details of the effects on different sectors. Goran, I just wanted to check, were there questions coming through online? We can perhaps just have a look at the questions online and then. Ooh, that looked like a really important, a really non-revenue related, but really interesting question. No questions? No, okay. All right, so the way I wanted to then wind up, where we at time-wise. Okay, let me start winding up anyway. So revenue is the most important line on your financial statements. Most of the time, revenue recognition applying IFRS 15 is very, very simple. Sorry, why is revenue the most important? Because this is where the company will sustainably earn income for the rest of its existence. If you as a company are not earning revenue, you're not going to exist because you need income for the company to continue. Something's got to pay the expenses. So revenue is the most important line in your performance statement because it tells you what is driving the company. Recognition of revenue from a time perspective is critical. And most of the fraud, if I have a look, the work Mike talked to you about this morning that he's done with the regulators, I work with the Johannesburg Stock Regulator. 50% of the frauds that occur are people trying to make their revenue numbers look better. Okay. They want to accelerate or they want to slow down. I remember in the days when I was at the bank and we wanted to check on, we were coming up to our year end, we would go to the deal makers and we'd ask them to open their drawers because what they would do is they would get in those days the check from the customer and then they would decide they've already made enough profit this year so they put it in their drawer and then they give us the check on the first day of the new year. Okay, because they decided enough profit already. Okay. What they did as deal makers, The reality is fraud is most likely to happen in this space because everybody knows the investors, everybody knows the people who pay bonuses look at revenue first and want to understand revenue. So IFRS 15 is trying very, very hard to tell you what is revenue, when you should recognize revenue, when you should not recognize revenue, and telling you where to put the revenue on the income statement to make it very clear. It is a very simple standard 99% of the time, as long as you remember that basic message we started with. And the basic message is, I recognize revenue when I deliver on my promise. If I have not delivered on my promise, I cannot recognize revenue. If I keep that in mind the whole way through, I have the basic simple thing that I should apply, the basic simple principle that happens all the time. Then the problem with that is it becomes very hard only on the margins. And the margins are very often specific. So I do some work in Malaysia. Malaysia's got the weirdest property law in terms of when properties can be transferred and what the obligations are. Do some work in Mauritius. Mauritius is the same. In Mauritius, for example, if somebody buys into a property estate, okay, what you do is you pay 50% deposit upfront, okay, for the property. Now, nothing's been built. It's just a piece of land. The land is assigned to you, but not registered in your name. But the builder cannot start building your property until they've sold 75% of the lots. So your money's sitting there, but nothing can happen until you get to 75%. And then when it gets to 75%, only then can they start the first building, but they cannot transfer the land until 75% of the building is finished. So they keep the land right up to the point that 75% is finished. Now, they do that to protect you. If the builder goes bankrupt at the 60% point and you have a half-finished complex with a house that's there but no roads, you just get your money back. Okay, because your money is kept in trust, you get paid back your money in full. So they're protecting you. But it means that even though there's my property, even though there's my house, the house is going up under my instructions, I have no control even when the house is finished until enough other houses are finished to say transfer happens. So the legal environment becomes really important. And I think I didn't get a chance to look at it. I actually forgot, but we got a really good online question about the details of transfer. And what I'm not going to do is I'm not going to look at the question now and try and answer on the fly. Do you remember the question I'm talking about? That long question. What I'm going to rather do is I'm going to take this home overnight because I know these questions are horribly complicated. And I'm going to think about it before I answer it. And we'll answer it tomorrow after the lunch break. So to the person who asked the question, I hope you don't mind waiting until tomorrow. And Goran, I'm looking at you like you asked the question. But to the person who asked the question, I won't be answering it until tomorrow. Hopefully you're here tomorrow and we'll give you a detailed answer back on that question. But as always, the easy stuff is very easy and those one or two hard ones are very hard. Any questions from the room? Revenue. Everybody happy? Everybody understands? Everybody comfortable? Yes, sir.
Excuse me, I was so confused. The recognition of the audit services. We have a common practice in Macedonia to recognize the revenues when the audit is done. But you mentioned that in some cases when the user of the audit statement is agreed with the auditor to pay in advance in different stages of audit, then you can, as I well understand you, that you can recognize the revenue in different stages of completion. We don't have that kind of practice in Macedonia because the audit is starting before the year.
Yep.
There is different stages and it's finished the next year. And we always recognize the revenue when the we send and give the audit report.
Applying IFRS 15, and I'm going to say there's got to be one condition. The condition has got to be, let me ask you the question. So you come, you do 75% of the work. Okay. Then you tell me, let's say you're going to qualify my report. So I fire you. Okay. Do I still have to pay you?
But as a penalty.
No. I'm actually paying you because you actually did work. And this is the way the standard would say.
Yes.
The standard would say, you have done work. The work is real. The work is recognized by both of us as real work. They're real hours that you're working to provide the service. That means, and if we have to stop for some reason, I still have to pay you for the work you've done, even if you haven't finished. In that case, what the standard says is, you are doing the work for me over time.
But I didn't give you a final report.
But it's not, you see, the thing is, I'm not paying you for the final report, because then you could do it very easily. You could just not come to my offices and just send me a report in the post, and then I pay you. So the point is, I'm not paying you for the report. I'm paying you for the work you do to get to the report. So as you do that work, you can recognize that revenue because you've done the work, you've earned the revenue. Done the work, earned the revenue. Then, as I say, if I fire you, you're going to get your money anyway, so you don't reverse your revenue. So it's not contingent revenue. You will get your revenue. So you are genuinely recognizing the work as you do it because that's the nature of the contract. So it changes practice there. And that's maybe the difference. So to an extent, and you might still in Macedonia be applying IS 18, and if you're applying IS 18, the distinction might be that that gave you a lot of latitude to decide. IFRS 15 is pretty definitive. If you can demand to be paid for the work you've done, you recognize revenue as you go along. Any other questions? All right. We'll hang around for a few minutes afterwards. If anybody wants any questions, you're welcome to come and ask me the questions directly. But otherwise, I'm going to say thank you very much for today. Thank you very much for being attentive today. Thank you very much for the guys online. And again, no questions online. Huh? Nothing. Okay, cool. So I just want to have a go at this question. In a case when net assets of a listed company are higher than its market value, because I really like this question. Did Mike answer this one? Okay. So here's a simple question and a nice, interesting question to just finish the day. So in a case where the net assets of a listed company are much higher than the market value, how do you deal with that inconsistency? So I think the first thing that this must do, if you are the accountant in the company, is it triggers one very simple question. Are the values of my assets correct? So should I be looking at impairing assets? If one of those asset values, for example, is goodwill, should I be thinking about whether that goodwill is valid? Because the market is saying I am worth less than the net value of my company. So the first question, asset test. Second question, if you're the manager of the company, what the market is telling you is you do not manage your assets very well. They're telling you that the underlying assets, if you've genuinely got underlying assets that are worth more than the company's worth on the market, the market is saying we are undervaluing your assets. We think the value of the asset should be lower. And that tells you that you need to change your managers. You need to change your strategy. Or what usually happens with a company like this is the shareholders at the next shareholder meeting will say, give us the assets. Declare the assets out as a dividend. This is a company that is ready for a takeover. Because if those assets are genuinely worth more on their own than they are in the business, then I want to be the one who buys it at the share price, and then I'm going to take those assets and sell them and make money. So I think what this is indicative of, and obviously there's a caution here, there may be other things happening in the market, there may be other uncertainties, and that's why the very first thing you do is you look at the value of the assets and say, what am I missing? Where is the thing that I'm not seeing? But if the asset value is correct on your balance sheet, this is the market telling you you're not managing your assets properly. I like that question. All right. And with that then, thank you very much, everybody. And we will see you tomorrow morning at 9 o'clock. I think Mike is on both times, both morning and afternoon tomorrow, but I'll probably come spend the afternoon here with him, just to keep him company and laugh at him. Okay, thank you very much, everybody.